there is a real risk the Fed is falling behind the curve here.
This Fed tends to move slow. They're watching with a rearview mirror.
The recent loosening in labor markets just suggests that there is some possibility for overshooting.
It's now about next year and the year thereafter where there's much more uncertainty.
It's not just that we don't know what the destination is. We don't know what the journey is.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 just about positive. Coming into Monday on a 5-day winning streak on the S&P 500 after posting the best week of the year, after posting the worst week of the year. This equity market's been all over the place going into a major week. A finely balanced Federal Reserve decision this Wednesday, Bramo. It could go one way or the other, 25 or 50.
And basically last week, risk assets got exactly what they wanted. The prospect, a greater chance of a 50 basis point rate cut without potential pain in the market, in the economy. And that, I think, is what has led to this surge with two-year yields going to the lowest since 2022. A deep emphasis on Tuesday's retail sales, considering the fact that this could suddenly tip the balance. This is the last data point of major economic data before that key knife's edge 50 basis points to 25 basis points meeting on Wednesday.
With a real feeling that maybe it could tilt things one way or the other. I was going through the research we both did, I'm sure, over the weekend. 25 basis points are nervous in Lincoln, BMO. Citi's Andrew Honhorst, 25 versus 50. The cut remains a close call. Things could change tomorrow morning.
Although Deutsche Bank really leaning into the point that you were making last week, and we discussed extensively, which is how much will it matter, the exact pace of cuts tomorrow or next week, when we get, or this week, I should say, on Wednesday, considering the fact that ultimately it matters the path. If they signal 50 basis points after that, they said if they cut by 25 basis points on Wednesday, they would expect a median of 75 basis points of cuts this year. If they cut by 50, that ratchets up the chance of 100 basis points of cuts or more for the entirety of the rest of this year.
It's a three-part act. We get a decision, we get some forecasts, we get a news conference as well. And that news conference for Chairman Powell is going to be a big, big deal. Speaking of big deals, to call this a chaotic election race, I think, is the understatement of the year. Things taking another turn over the weekend. Annmarie, gunfire on Donald Trump's Palm Beach golf course. Sunday afternoon, just another shocking turn of events.
Absolutely. Now, the FBI is investigating this, saying that this is an attempted assassination on the former president, the second one in 2 months. And really, all the questions now, Jonathan, are going to be about, is the Secret Service doing enough? Is there enough protection around the former president, who is the candidate on the Republican side? This is what the Palm Beach County Sheriff had to come out and say yesterday. If Trump was the sitting president, we would have had this entire golf course surrounded. What did happen yesterday, though, is that a Secret Service individual was almost an advance team. He was in the hole ahead of Trump and saw the butt of the rifle coming through the bushes. And that's how they were able to then chase this man down who was fleeing, apprehend him on I-95 in a neighboring county. But a lot of questions about how potentially this may change the course of his protection as we head towards November 5th.
Also, a lot of questions about exactly what the motivation was of this 58-year-old man who has been apprehended. But a real question here, we've got 50 days left. What else can happen?
Shocking.
I mean, this is to Anne-Marie's point of how tumultuous this election season has been. To call that the most understated comment of the year, you can't really imagine much else.
Absolutely shocking. If you are just joining us, welcome to the program. Just a snapshot of things cross-asset for you. Equity futures on the S&P 500, just about positive here. In the bond market, unchanged on a 10-year, 365. In the FX market, the euro a bit stronger against the weaker dollar this morning, 111.22. The dollar near the lows of the year, and dollar yen, Lisa, making a break below 140 just briefly for the first time in 2024.
And this comes ahead of the Bank of Japan meeting on Friday, and it comes as the long positioning on the Japanese yen. This, according to Kit Jukes over at Societe Generale, rose to the most going back to 2016. Talk about a whipsaw in positioning. We saw the short positioning just completely dominant, and all of a sudden now long overwhelmingly, which raises the prospect of potential dollar weakness heading into the election, heading into the rate cuts, as well as just versus some of these other currencies that have been underbid.
Dollar yen, 140. 13. Coming up this hour, we'll catch up with Rob Casey of Signum Global Advisors following a second assassination attempt on former President Donald Trump. Laurie Calvasina of RBC Capital Markets after stocks posted their strongest week of the year, and Neela Richardson of ADP ahead of the Fed's big decision later this week. We begin with our top story. Former President Donald Trump is safe after what the FBI is calling an apparent assassination attempt. Secret Service opening fire at a man with an assault rifle at Trump's golf course in West Palm Beach, Florida, just yesterday. The incident marking the second attempt on the Republican presidential candidate's life in only 2 months. Jack Fitzpatrick of Bloomberg Government joins us now for more. Good morning, Jack. What is the latest this morning?
Well, first, the basics. A number of statements from congressional leaders, President Biden, Vice President Harris, saying political violence is wrong. At the very least, there are the expected statements on that front. After that, there's plenty of work to do and confusion at this point. There's plenty of scrutiny on the Secret Service because of the July assassination attempt on former President Trump, and that will only be ramped up. There's a bipartisan task force in Congress that was created to investigate what happened in July. They have called for further investigations into this event. The bill to give a budget to the Secret Service had already been delayed a bit as senators looked into if they need more resources for the Secret Service or if it's just a matter of oversight and accountability. This will likely complicate the efforts to determine if they need more resources or if something just needs to change organizationally at the Secret Service. And of course, there's the question of how this affects the campaign, which is very unpredictable. Looking back to July, it was only 8 days later, despite the spotlight on the assassination attempt in July, 8 days later that President Biden said he would no longer be the nominee. So it's difficult to predict exactly what we'll even be talking about a week or so from now on a very chaotic campaign trail. But there is work to be done in terms of scrutinizing the Secret Service on Capitol Hill in particular.
Right, and they created that bipartisan task force after the first assassination attempt on the former president. What can we expect from that House task force now, Jack?
Well, first, the Secret Service director at the time stepped down, so we are past the point of simple accountability and a change of leadership. As I mentioned, there are questions about if the Secret Service needs more resources in the short term, more money, more people on the ground. They said to senators in a letter just last week that the issues in July, their failures in July, were not because of a shortage of resources. So again, there's going to be a short-term and long-term look at what needs to change at the Secret Service. But the question of if there was some shortage of their ability to get people on the ground was answered with a no. There's going to be a lot of scrutiny on Capitol Hill and demands for answers. But this is an agency that initially, just last week, had said they have enough resources to do their job.
Hey, Jack, appreciate the update. Thank you, sir. Jack Fitzpatrick there of Bloomberg. Any more details when we get them, we'll bring them to you. Let's continue this conversation with Rob Casey of Signum Global Advisors. Rob, good morning to you, sir.
Morning.
Another almost tragic event over the weekend. 2 very lucky escapes over the last 2 months for the former president. What does this change? Does this change anything at all?
You know, I don't think it changes a whole lot, certainly not as much as the first assassination attempt where we saw, photo after photo of Donald Trump bleeding, standing, raising his fist. This, a little bit less interesting to the general public. But I think it points to the fact that the October surprise this year very well could be an example of political violence.
When you look at the timeline to November 5th, does Trump need to change how he campaigns now?
I don't think he needs to change how he campaigns. Now, maybe we'll see him play a little bit less golf, but probably not. I mean, as the sitting president, he liked to travel to his golf courses. As a candidate, he's certainly done the same thing. Now, how he campaigns, I think this really only plays to his advantage. Now, obviously, we're all very grateful that he's safe, but up until that point where he's not safe, I think this riles up his base and ensures that Republicans will turn out in November.
Jack was just talking about what's going on with this task force. They're still investigating what happened 2 months ago. How quickly can Congress move and potentially beefing up his protection? We heard from the Palm Beach County Sheriff yesterday saying if it was the sitting president, potentially there would be a bigger perimeter around the West Palm Beach golf course.
Yeah, unfortunately or fortunately, it's not really up to Congress how good Trump's protection is, right? It's a question of Secret Service. President Joe Biden, Vice President Kamala Harris have assured us over the weekend that Trump's protection is good, right? It's as much as a candidate needs to have. But that being said, I wouldn't be surprised if they beefed it up pretty close to essentially what the sitting president receives. Now, Donald Trump is not the sitting president, but he's 6 weeks away from potentially being reelected. So I would not be surprised if President Biden, frankly came out and said, we're going to give Donald Trump more.
Rob, you said something that I want to pick up on. You said that the October surprise that we may see could be an act of political violence. What makes you say that?
Well, of course, we've seen 2 attempts on former President Donald Trump's life. So that's the first. The second is, our country is horribly divided. And I think to a certain extent, politicians are playing into that and will play into that between now and November. I think the example sort of coming from the other side is Trump and vice presidential candidate J.D. Vance, talking about these illegal immigrants in Ohio, Haitians eating dogs and cats, things of that nature. They're actually legal immigrants. But it's rhetoric like that I think, frankly, could incite this kind of lone wolf violence that is so hard to defend against.
So what's your sort of analogy? I mean, has there ever been a time or any other election cycle that you can think of that had this type of risk, or is this a new and heightened risk that requires a very different type of security and a different type of campaigning?
I think it's at least in the modern American era, this is new, right? We haven't seen attempted assassinations like this in my lifetime and in all of our lifetimes. You can go back to probably the Civil War to see when our country was most divided. I don't think we get there, right? And the hope is that the Secret Service is able to protect, obviously, the sitting president, the former President Trump, and Kamala Harris, and they're doing their best. And it's important to say that none of these attempted assassinations have been successful. Now, obviously, the first one was very close and very scary.
Yep.
Second one, not so much.
Let's talk about the Harris campaign. The first time, we had the Biden campaign. And the criticism at the time was that it was a one-dimensional campaign centered around characterizing Trump as an existential threat to democracy. There's a lot of criticism about that in the middle of July. Does the Harris campaign have enough facets to it? Is it a multifaceted campaign that they're not relying on this single issue, that they can back away from talking about this a little bit more?
Yeah, I think they can. The issue with the question of democracy as a campaign issue is that it's, 100% of people are worried about it, but it splits 50-50, right? Republicans are worried about how Democrats are a threat to democracy. Same thing, vice versa. So, did it incite the first attempted assassination against Donald Trump? We're not really sure. Who knows? The motives of that shooter remain unclear. But, as a question of, can the Harris campaign do more? They better, right? Because I'm not sure they're going to win on this single question of democracy. They have to win on abortion. There's more messaging around a middle-class economy and opportunity economy than we saw from Biden, who didn't want to talk about the economy at all. So Harris is doing more. I think she has to do more to win.
Talk to us about how Harris is addressing the U.S. economy, because we all saw that interview going into the weekend. It wasn't impressive. Some very simple questions that weren't really answered. What is the opportunity economy? What are the policies behind it?
I think the policies that she wants to highlight first and foremost are the housing policies. After that, it sort of falls off, right? And I think what's important about these policies, what many of us know, is that not a lot is going to get through Congress. So it's not as though she can promise, huge reforms, huge changes, because if she sits in the seat, if she wins the election, she's very likely going to have a divided Congress. And I would agree, John, that the interview on Friday, not all that impressive. I think it's probably why we haven't seen her do a whole lot of interviews, why we probably won't see her do a whole lot of interviews between now and November. On the one hand, she's a candidate who absolutely turns out the base. On the other hand, maybe that they want to do their best to insulate her and just maintain the momentum that they have. Certainly that she won in the debate on Tuesday night.
Just quickly, just to wrap things up, base case for you and the team, what is it? Does it remain the same?
It remains the same. 65% chance Harris win. So we think that's base case. With a divided government, the Senate goes red, the House goes blue, and that really limits what Harris is able to do, at least until the midterms.
OK. Rob, it's good to see you. Thank you, sir. Appreciate the input. Rob Casey there of Signum Global Advisors. If you are just joining us, equity futures now totally unchanged on the S&P 500. Let's take the opportunity, just a few minutes, to get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Israeli Prime Minister Benjamin Netanyahu is warning the Houthi militant group that it will pay a heavy price after a hypersonic missile landed in central Israel over the weekend. The Iran-backed group fired a missile that evaded interception by Israeli and U.S. forces. No deaths were reported, but it marks a setback for Israel's air defense system. A string of misses from economic data out of China, especially on industrial production. Now, the calls continue to mount for Chinese authorities to increase stimulus if they want to hit their 5% growth target. The PBOC has indicated that there's more, at least monetary easing ahead. Goldman, Citi, and Morgan Stanley are all among the banks that have downgraded their forecast for China this year. Boeing's credit is at risk of being cut to junk by Moody's. On Friday, the ratings agency placed the plane maker on review for a downgrade. Boeing has $45 billion in net debt, and it's been bleeding cash after paring back output following that near-catastrophic Air Alaska incident in January. The Moody's announcement comes as Boeing workers strike further, and that threatens production and cash flow. That's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, betting big on big rate cuts.
As we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly.
That conversation just around the corner. Live from New York City this morning. Good morning. Five-day winning streak on the S&P 500, the longest since the middle of August. We closed that five-day winning streak on Friday. Let's see what we get this morning. This morning we look like this, just about positive on the S&P. The outperformance on the Russell, the small caps. The small caps last week, a gain of 4.36%. Quite a nice week of gains for the small caps in America on the week last week. Under surveillance this morning, betting big on big rate cuts.
Whether we get 25 or 50, the point is that we're starting on the journey. So as we start to see a little bit more loosening of financial conditions, that's going to be helpful for equities broadly. Assuming we don't have a recession, that we do see a soft landing, you could even see markets slightly higher than that.
So here's the latest this morning. Stocks coming off the back of the best week of the year as investors gear up for the Fed's big decision on Wednesday. The central bank expected to cut rates by at least 25 basis points, with some traders preparing for a larger 50 basis point move. Laurie Calvasino of RBC joins us now for more. Laurie, I know the house view is 25, and I just wonder if we get that 25. And of course, welcome to the program, by the way. If we do get that 25, how vulnerable certain trades like the small caps actually are?
Hi, John. So thanks for having me. Look, I think it's a great question. And we were watching the small caps just surge on Friday as the renewed optimism about the 50 basis point cut came up as well. And look, I think small caps have a lot going for them. But the reality is that valuations are full and positioning is also full. If you go back a few months ago, they looked underowned. They looked cheap. We're just not there anymore. And now we've got a lot of Fed optimism baked in. So I do think in the short term, at least, if we're just thinking about the week ahead, I do worry a bit that if we get the 25 rather than the 50, which propelled small caps to these great heights on Friday, that there could be a bit of a reversion in the small caps. I think that, we really have sort of more of the fast money crowd sort of driving that trade right now. If you look at recent flows into small cap, they have been all passive driven, and that passive money does tend to be very, very fickle.
You have a nuanced view here, Laurie, with respect to not only how much the Fed cuts, but also the economic data behind it that needs to keep this going. There was this feeling that the Fed was on track to cut by 50 basis points without real pain visible in the U.S. economy. How much is any kind of weakening, even if not a recession, sort of a bear case right now for small caps?
So I think the small caps really need the needle to be threaded. And what I mean by that is if you go back and look at past cutting cycles, small caps do really, really well and embark on a longer term outperformance cycle if you get a recession, if you break the economy. It's small cap 101 to say you sell them on the way into a recession, you buy them on the way out. And you tend to see that pivot midway through. But if we don't get that and we get some sort of economy that's still growing, I do think it depends on what kind of growth we get. And if you look at the other side of the equation, we really do need a hot economy, above average GDP for small caps to really keep going if you look at recent trading data since, say, 2015, 2016. And if we're just, I think it comes down, Lisa, what do you mean by soft landing? A soft landing that's looking at like 1.5% type GDP growth, maybe even 2%. I don't think that quite cuts it for small cap. I think you need something more like 2.5% to 3% or better.
When you broaden out beyond small caps, you say you remain neutral on the S&P 500 as we get closer to your year-end target. You talk about sentiment and how it concerns you. Can you explain why investor sentiment right now is a red flag?
Sure, it's a great question, Lisa. And look, I would say if you look at AAII net bullishness, I think that's the best barometer. It's been doing the best job the last couple years at calling short-term inflections in the market. And it's really flirting with danger. If you look at where it's been recently, it's been kind of hovering right around that 1 standard deviation mark, poking above it on certain weeks, but not quite on the 4-week average. And that's very similar to what we saw back in July. That's very similar to what we saw back in August of last year. And if you look at CFTC data, which is going to give you more of an institutional look, that data just continues to make new highs. And it's above levels that we were at in early 2018 and early 2020 pre-COVID. And it's well above the highs that we've seen mark the peak in recent years in kind of that post-COVID era. Look, sentiment and positioning are not the only thing that drives stocks, and we certainly can stay overbought for quite some time. But I do think it tells me that we're really not sitting here in a position where we can absorb any kind of bad news easily. So those are charts, frankly, Lisa, that keep me up at night, even though we've had a more constructive view on equities overall.
Lori, do you still see a connection from a Trump win and small caps rallying?
It's a great question, Annmarie. So, if we look back to 2023, 2024, we really just haven't seen that linkage, right, where Trump's doing well in the betting markets and small caps are outperforming. We've really seen Trump more closely aligned with large caps, with growth. Things are starting to change there a bit recently, so I would say we'll have to watch the data. One of the things we did mention in our piece this morning is that if the Harris corporate tax increases, raising the rate from 21% to 28%, were to go through, I do think that's a negative signal for small cap, because if you go back into the 2016-2017 period, small caps were one of the big beneficiaries of the rate cut. And that's not just to simply say the historical playbook, flips on its head. We have to go back to the why. And what we found back then was that small caps were more direct payers of the headline rate. They had a tougher time managing their taxes lower than large cap companies did. So I think that issue may come up if we end up seeing Harris win and those corporate tax hikes are on the table. Of course, I think that really only happens, in a Democratic sweep scenario, which is not really our base case.
Lori, you've been looking at both these candidates' plans. I saw you at Trump's economic speech here in New York City. What big questions are still missing as you think about and you put these into your models?
So, look, I think it's really preliminary for both candidates, right? I think that they've both taken some heat for lack of detail. From my perspective, maybe my expectations are just low all around. I think this is maybe the 5th or 6th presidential election I've covered as a strategist. But I'm really just looking for kernels of where they're leaning, of what their wish lists are, of what their impulses are. So I think, when I look going forward, I think maybe on the tax side, for corporate taxes at least, we have a little bit more clarity on the Harris side. I left the speech confused about exactly what Trump wants to do in terms of further tax cuts, the commentary of linking the 15% rate to domestic production. I don't exactly know how that shakes out in the S&P 500. We have lots and lots of companies that are producing things overseas. So I think it's tough for me to sit here when I'm looking at my earnings model to just bake in a 15% corporate tax rate. I think it's much more complicated than that.
We feel your pain for policy on both sides. Lori, thank you. Lori Calvasina of RBC. Lori saying at the start of the year, this whole conversation was like staring at the sun. It feels like we're staring at the sun. November 7th. Why is November 7th so important? I really do believe there's a chance we look back on September 18th as the relatively easier decision for the Federal Reserve. November 7th is the next Fed meeting after the one this week. On November 7th, they'll have a much better idea of the politics and policy for 2025. Setting policy around that could be quite challenging.
Especially since what is the policy going to be if they have to pass legislation? How can they extrapolate out some of the promised proposals versus what is actually going to come to pass? And then how politically motivated are they accused of being if they move in accordance to what they expect may or may not happen with respect to inflationary or deficit increasing policies in 2025?
They'll have a lot of answers on November 7th, but they will not have them all. To Lisa's point, the composition of Congress and the backroom dealings of when it comes to the tax cuts, trying to get them through. What are they going to allow potentially to just sunset when it comes to the former president's tax cuts? But then you have to look at the White House. And whether or not it's Trump or Harris, the Fed will have a lot more answers on tariffs and whether or not they are going to be used potentially as a carrot and stick approach of former President Donald Trump, or will they be walls up almost immediately, which many people say is very inflationary, and potentially you could see the Fed thinking about hikes.
Adam Poston at the Peterson Institute making that point. He thinks we need to get ahead of this conversation. We'll try and get ahead of this week, a big week ahead. Coming up next, Neil Richardson of ADP saying saying don't take disinflation for granted. That conversation just around the corner on the S&P 500, slightly negative on the S&P, but only just. We're basically unchanged on the S&P 500, coming off the back of the best weekly performance of the year so far on the S&P 500. From New York, this is Bloomberg. Quiet start to a big week ahead. Live from New York City this morning. Good morning to you all. Equity futures on the S&P just turning negative, just a touch. The outperformance again on the Russell, the small caps up by 0.6%. The run of gains on the S&P though, pretty impressive. 5 days of gains on the S&P 500. Lisa, the best week of gains so far in 2024.
And it was multifaceted. It was driven actually by the big tech names. It wasn't just small caps. It was everything. You saw the best weekly performance for this year for both the S&P and the NASDAQ. That said, how much is it banking on a 50 basis point rate cut for the right reason, which is the Fed's just going to do the right thing, according to one luminary on Wall Street, because ultimately it doesn't seem like there was real weakness behind the Fed's sort of seeming shift, or at least the market's perceived sense of the Fed's shift with respect to how big the rate cut will be on Wednesday.
Got to define what doing the right thing means on Wall Street. Doing the right thing on Wall Street means whatever I think the Federal Reserve should do. That's doing the right thing on Wall Street.
Is that what you're saying about Michael Ferroli over at JP Morgan?
I'm just suggesting that if you're forecasting 50, you probably believe 50 is the right thing, correct?
A lot of people think that 50 is the right thing. I'm going to deflect completely. Greg Ip over at the Wall Street Journal writing an editorial on this. You have others as well coming out and talking about how it is the right thing to do at a time where the baseline rate is too high for the overall economy. Question will be, how much more does the market move if they do go by 50? So is that basically going to be effectuating some kind of 150 basis points of rate cuts for 2024 if you go by 50 on Wednesday?
You're right to suggest it was the everything rally because it felt like it. Nvidia was in the mix. Ally Financial and their concerns feels like a lifetime ago, given the S&P 500 and the gain it had to close out Friday.
There was this one report I was reading about whether Ally was an anomaly or not. And if you take a look at some of the other lenders in a similar sphere, they didn't see the same kind of sell-off. It seemed like the market viewed Ally as sort of an outlier with respect to its risks, and they didn't give guidance in terms of how much they expected their delinquencies to increase. Still a big question mark at a time where people are saying corporations have plenty of capital. Consumers, around the margins, some signs of fraying.
Bank earnings about a month away. Let's switch up the board and turn to the bonds. 2-year, 10-year, 30-year sit at the front end of the market. The two-year yield was down last week by around about 6 basis points, declining given that we already had hot CPI, hot PPI and decent jobless claims numbers. It's kind of surprising that the bond market was still bid at the front end, which I just think speaks to the bias to buy in this bond market, regardless of what the data looks like at the moment.
Are you suggesting that people were baking in rate cuts without necessarily economic data to justify it?
I might be knocking on the door of that suggestion.
Well, that seems to be what basically was really supporting risk assets, because essentially you are correct. Ding, ding, ding. We saw the lowest rates on the 2-year going back to 2022. And why? Entirely because some people said of basically a regurgitation of some points in the Wall Street Journal and the Financial Times that hinted at maybe this being an active conversation about a 50 basis point cut on Wednesday. Look, bottom line is it really has to do with the projections out. I want to lean on what Deutsche Bank was saying and something that conversation we've had here. It doesn't matter as much 25 or 50. It matters the trajectory and the dot plot. We're going to be talking a lot about that.
We will.
And some of the guidance in the press conference.
And the dispersion as well as some of the forecasts, how wide the range is on the FOMC. This is unlocking another leg of dollar weakness. So dollar yen broke 140 for the first time this year, trading in the 130s for the first time in 2024. Dollar yen down to about 140 flat right now, Lisa. We're negative 0.6%. So that's some Japanese yen strength on the screen. That's some euro strength on the screen. Euro dollar 111.28.
And how much is this baking in a 50 basis point cut for the Federal Reserve that will add to this dollar weakness? And how much is it just that you have the Japanese economy moving in the opposite direction? The Bank of Japan on deck potentially on Friday to hike rates again. A lot of people don't think they're going to, but they're poised to again. Are we at peak dollar weakness for the moment, or do we see a lot more? Note after note, dollar weakness is probably not going to be that much more pronounced, but that might be the gradual trend going forward.
It's the bulk of the move behind us. A conversation on that in about 15 minutes' time. Under surveillance this morning, the FBI investigating a second apparent assassination attempt on former President Donald Trump. Secret Service agents opening fire at a man with an assault rifle at Trump's West Palm Beach golf course just yesterday. A suspect identified as Ryan Ruth is in custody. Donald Trump is safe and unharmed. Thank goodness.
Thank goodness. We'd be having a very different conversation today if that Secret Service agent inside the golf course didn't see this rifle poking through the fence. What kind of conversation would we be having this morning? This individual is about 300 to 500 yards away. I think what's really coming into focus now is how to protect the former president, given this is the second assassination attempt on his life. The FBI is involved. This is going to go to the federal authorities. But really what came into focus yesterday was what the Palm Beach County Sheriff said, which was that potentially the parameter by which the Secret Service has in terms of protecting the president would be bigger if it was a sitting president. Joe Biden has come out and said, though, that they want to make sure that he's given every protection and precaution necessary.
Another shocking turn of events over the weekend. We'll be in touch with the team down in Washington all morning. Any updates as we get them, we'll share them with you. I want to turn to this story. Jefferies saying possible Volkswagen plant closures this year could pave the way for more than 15,000 job cuts. The automaker could close production facilities without needing approval from the supervisory board, leading to possible provisions of as much as $4.4 billion in the fourth quarter. This all according to the analyst, Lisa, over at Jefferies.
And shows the heightening concern over in the German auto manufacturing sector as you do have this increasing pressure from Chinese manufacturers and others. I spent some time with Mario Draghi's memo over the weekend, and this idea that he kind of wants Europe to embrace a U.S. type of model in order to avoid some sort of stagnation. The difficulty in doing that with all of the red tape and with the pushback that you've got, what is the logical outcome if they can't? And really that, I think, is what you see a lot of these automakers struggling with.
Also, potentially, how much is the negotiating tool? This is from a memo from Jefferies. They're citing comments from VW made during a roadshow in North America. Quote, unions should feel pressure to reach new agreements while VW will be in a position to force layoffs. So potentially this brings more people to the board because we know that the union is on the supervisory board.
There is a lot of excess capacity in European auto manufacturing right now, and how that gets resolved, reconciled over the next year or so could be pretty brutal. Elsewhere, investors preparing for a big week ahead with the Fed taking center stage on Wednesday. Fresh economic data also in the pipeline with retail sales tomorrow and jobless claims on Thursday. Neela Richardson of ADP writing, it would be easy to ignore the economic news this week and pay attention only to Wednesday's Federal Reserve vote on interest rates. I caution you don't. Even with a Fed meeting on the calendar, there will be much more important data news to watch. I'm pleased to say that Neela is with us around the table. Neela, good morning to you.
Good morning.
Let's start there. Let's start beyond the Federal Reserve decision. Jobless claims Thursday, retail sales tomorrow morning. What are you looking for?
The strength of the consumer. What's unique about this potential cutting cycle? First of all, the Fed hiked rates 11 times. So this could be a really long game. It's not just a one and done move, as we all know, and we don't know how long it's going to take, but it's going to depend on the strength of the consumer. And so when you look at retail sales, when you look at consumer spending, the bulk of the economy, if the consumer is still holding up, what that means is that the Fed is going to be cutting into a pretty good economy. And we don't have a lot of benchmarks for what that looks like.
How would you characterize where the economy is at currently? If I look at the data and just the levels, we can get to the change and how important the change is, but the levels are still pretty decent. Unemployment around 4%, jobless claims in at around 230. If we listen to the companies, some of the consumer-facing companies have been warning about a weaker consumer. Dollar General, an example of that. Ally Financial last week, a decent example of that. How are you seeing things?
If the Fed was in this economy 15 years ago, I think we'd have a different conversation. This is a pretty good economy. Yes, there's some things to be concerned about. I'm really concerned in the jobs market about how segmented the concentration of hiring is, how weak manufacturing is. For the consumer side, I am concerned about the very low savings rate, very much lower than historical averages. I'm always concerned about housing in this economy because it's such a driver of inflation. But when you look at these jobless claims that'll come out on Thursday, I think what you'll see is pretty moderate low levels of initial jobless claims signaling layoffs. What we're not seeing is big job losses. That's unique in a Fed rate cutting cycle.
Some people might argue that's a lagging indicator, and we don't see the layoffs until it's too late for the Fed to act, which is one of the big arguments why doing the right thing means cutting 50 basis points on Wednesday. The note of caution that you had in your recent writings was household wealth as well as housing prices, and how that indicates a very different consumer in terms of resilience than some of these other peripheral weakening data points that people point to. Why is that?
Yes, the criticism with the Fed is that they always act too late, and that's why the job losses are a lagging indicator. But yeah, in other times when we've seen this huge increase in home equity, and we have, homeowners are sitting on record levels of home equity because of rock bottom mortgage rates before the pandemic and super high house prices. That's really driving a big explosion in household wealth. Well, in previous times when equity was this high, what households did was they just refinanced, tapped that equity out and bought cars, went on vacations, paid off student loan debt. They did all these things that actually leads to more consumer spending and gives a pop to the economy. Will they do those things again when mortgage rates come down, when it's less costly to refinance? I think so. You're sitting on a lot of wealth. That wealth could be an ATM for future, especially if savings rates are down. And housing wealth is a little easier to tap into than stock market wealth. More households have access to housing wealth. Home ownership is at around 65% in this country, which means that a lot of people are sitting on some money and they may want to access that to fund their spending and purchases.
That said, some people might argue that this market is already priced in well more than 50 basis points of rate cuts. And what you see in the actual benchmark rates that are the borrowing costs, the pegs to a lot of borrowing costs for consumers currently, they already reflect that. So why not just do it and then allow things to sort of evolve from here? Do you see any real reflationary type of pressure kind of building in markets that should really push back aggressively against that idea?
I think one comment during those Jackson Hole meetings that was played but maybe ignored this week is President Harker's comments that the Fed needs to commit. It's not just about this 1 month. It's about the commitment that they illustrate over the next several months. And if they commit to a moderate rate cutting cycle, I think that will give some ease in terms of the market's ability to project the next move. If it seems like we're going to be data dependent, we're going to watch each month, it might be 50 basis points next month or the month after, maybe we pause. If there's some uncertainty, I think that's going to cause a lot of gyration in the market.
Neela, when you say there's no foregone conclusion on inflation, you point to housing.
Yes.
And then you look at, say, Kamala Harris's housing plan of a $25,000 subsidy. How inflationary is potential policies like that?
I don't really think they move the needle, and here's why. The demographics are behind a housing tailwind. If you look at the demographics in this country, Gen Z, millennials reaching peak home buying age, there's plenty of demand. You don't even actually have to amplify it. What there's lacking is supply. That's the issue. And so you have to have that two-tier housing plan. I think there's been some good plans that both meet supply and demand, but without inventory increases, we're not going to solve this issue of very low vacancy rates. We are at like half the historical rate of vacancies. 0.8% of all housing is unoccupied. That's super low. And that means housing is going to continue to put pressure on prices and inflation.
I guess one of the big issues, though, is that you can get the subsidy quicker, potentially, than there actually would be.
I mean, it's short-term, long-term. House prices are really high. They're unaffordable for many people. And they're unaffordable because of high mortgage rates. We might get some relief on there. They're unaffordable because people can't save because housing costs are so high. So you need a down payment. That might be helped by a little bit of money coming their way in terms of a down payment. And they're unaffordable. The big reason why it's unaffordable is because of inventory. So that is the big picture solution that has to be solved.
Just to put a bow on it for the people tuning in, 25 or 50? Wednesday?
I think it's 25.
25?
I know. It's controversial, but I think it's 25.
25 became controversial in the last week. It's something, isn't it, how things have shifted. Neela Richardson there of ADP, and of course a Bloomberg contributor. This just in from the former New York Fed President Bill Dudley, the Fed should go big now, and I think it will.
And this, to me, follows some of his previous comments. He explained why. He said that there are two objectives to the Fed's mandate: price stability and maximal sustainable employment. Since they have come much closer into balance, it suggests a neutral benchmark rate by the Federal Reserve. They say they remain far from it, and therefore it matters getting there quickly to try to stave off any kind of increase in unemployment. And he said the goal is to give a better sense of the destination rather than the pace. And if you move quickly and you get there quickly, that will actually have a much more beneficial kind of effect on the overall economy.
Things are so finely balanced. We'll keep returning to that article. It's on Bloomberg Opinion this morning. We'll come back to that in about 5 minutes' time. Equity futures on the S&P 500 just about unchanged, with an update of stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. U.S. and British officials are increasingly concerned that Russia is supplying Iran with nuclear weapons technology. Western officials tell Bloomberg that they fear the Kremlin is trading nuclear secrets in exchange for ballistic missiles to use in its war with Ukraine. President Biden is set to meet with Ukrainian President Volodymyr Zelensky at the UN General Assembly next week to discuss his war strategy ahead of the U.S. election. Disney and DirecTV have reached a contract that will restore customers access to Disney-owned networks like ESPN and ABC. DirecTV agreed to pay market-based rates to carry the channels. It also secured rights to offer a skinnier package of channels for fans of sports, entertainment, and kids programming. The channels had been dark since September 1st for roughly 11 million DirecTV subscribers during those negotiations. And that's your brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. Up next on this program, testing dollar dominance.
Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects.
That conversation just around the corner. You're watching Bloomberg TV. Doing okay. We're just about unchanged on the S&P. We're spoiled. Best week of gains on the S&P 500 this year, just last week. Sort of the same move on a Russell. Really decent week of gains as well on a Russell. Small caps participating, big tech participating. I have to say, Lisa, we mentioned this a couple of times. Financials, I think, maybe the weak spot last week. A bit of uncertainty around the signals we were getting from Ally Financial and JP Morgan alike in conference season.
It was sort of the 1-2 punch. Net interest margins under pressure at JP Morgan, and then questions around consumer creditworthiness on the other hand. It's sort of this difficult scenario that's hard to reconcile at a time where otherwise other signals seem to be really positive, both about the consumer as well as the broader economy.
Signals from the bond market and the broader economy. Broader economy seems to be okay, looking at jobless claims exclusively, specifically. Yet you're still going to get those interest rate reductions, anticipating what we might get on Wednesday. Bond yields this morning down just a touch on a 10-year maturity. The 10-year at the moment, 364.75. Under surveillance this morning, testing dollar dominance.
It's going to be difficult to shift away given the dominance of the dollar in practically every dimension as a medium of exchange, as a unit of account, and as a reserve currency. Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects. I think we will end up in a system where the dollar is still the most dominant, perhaps a little less dominant than it is right now. And there is a lot more fragmentation, which means there is no serious rival to the dollar.
So here's the latest. The US dollar falling to its weakest level of the year, with currency traders gearing up for a trio of central bank decisions from the Fed, BOE and BOJ. Skylar Montgomery-Koenig of Barclays writing, the dollar typically weakens ahead of Fed cycles. The move has already been chunky by historical standards. We're still at a stage when bouts of further dollar weakness are likely, but a large part of the dollar move is probably behind us. Skylar joins us now for more. So Skylar, let's pick up on that last line. Why do you think the bigger chunk of the move might already be behind us?
Yeah, I'll give you a few reasons for that. I mean, the first is just positioning has shifted massively, right? We've gone from being max bullish long dollars on our sentiment indicator to max bearish dollars, and it's ticked up a little bit, but that sentiment is certainly still bearish. The other reason I'll give you is that you have previous historic easing cycles, and what you see is you do get dollar weakness into the first cut, but it's very front loaded. After the first cut, the market realizes that either it's a hard landing and you need safe haven flows for the dollar, and that supports the dollar, dollar, or it's a growth scare. It's not as bad as was originally thought. And that means U.S. growth is still strong, and that can feed positively into the dollar as well. And the main reason there is because in soft landings, the market overestimates how much easing the Fed actually delivers. And we think that's what's happening now as well. There's too much dovishness priced in the U.S.
So let's put aside for 1 minute the idea of Fed expectations and go to this question that was raised in the earlier commentary about what's the alternative? How much could the other side of the trade, whether it's a Bank of Japan hike on Friday with more hikes indicated later on, or potentially some sort of action from the Bank of England that is less than people had expected? I mean, the other side of the trade, how much could that send more dollar weakness?
Yeah, I mean, this is the hard bit, right? It's from a growth perspective. Certainly, there's not an impetus from the other side of the trade. Europe looks exceptionally weak. If you think about the U.S. and China as being the global growth engines, the U.S. is the only bit that's really chugging along right now. China isn't stimulating the rest of the world. It's not happening in Europe. It's not helping the UK, and it's, not feeding into commodities and thus these cyclical currencies like Aussie and CAD. I think on the interest rate bit, the big difference between the U.S. and Europe and the UK is they're significantly more priced in the U.S. And so I think the issue is because there's already that differential, you'd imagine that even if you expect more from the U.S., you need a closing of that gap in terms of more dovishness priced in Europe relative. And so, we are going to see less from these banks this week in terms of these are meetings where the Bank of England's not likely to cut. It's a meeting where the Bank of Japan is likely to stay on hold because they're assessing what happened after the hike. But the growth backdrop isn't meant, or it's not pro having a divergence in policy to the extent that the market prices.
Skylar, how much does it matter to you whether the Fed cuts by 25 or 50 basis points on Wednesday?
Yeah, I think certainly for the dollar, it'll be quite binary for this week. In terms of the market's kind of pricing 50-50, we've had this rapid shift from the data indicating it should be a 25 basis point cut to kind of commentary and news saying that maybe it should be 50 basis points. And that means that when we get to this meeting, you could have a binary reaction where if it is 50 basis points, the dollar sells off. And if it's 25 basis points, the dollar rallies. Beyond that point, though, more medium term, it matters where the landing zone is. And that's the overarching theme that we're talking about in terms of we think we get to a 4% terminal rate. The market's pricing under 3%. It's very hard to price more than that. If you think we get a soft landing, then you think you're going below neutral, you're going into easing territory. And that indicates that you're thinking about a recession more, which should also be dollar positive. So, yes, it certainly matters for the price action in the coming weeks. But I think more medium term, it's where the landing zone is that does.
Skylar, when you take all this into account, obviously everyone is laser focused on what the Fed does. But after that and the politics come into focus, what do you make of Trump talking about debasing the U.S. dollar?
Yes. So, yes, Trump has called for a weaker dollar, but most of his policies are actually dollar supportive, right? And we think the cost of weakening the dollar would be too high. In terms of how he could, there are options. There are three kind of avenues you could point to. It could be fiscal consolidation, it could be eroding of the Fed's independence, or you could do direct intervention. On fiscal, I just think there's very little political appetite. On monetary policy, I think there are institutional checks that make it less likely. But I think we'd also say that keeping monetary policy unnecessarily loose would spur inflation. So that's, again, a very politically unpopular option. And then just on direct intervention, I think multilateral interventions seem unlikely because you have dollar counterparts and they're unlikely to want to take the export hit from a stronger currency. And then unilateral intervention, historically, it's not done very well, but it would probably also necessitate treasury selling, which would raise yields, which, again, is not something that they want to do as an option. And so any option that you could take to weaken the dollar, I think, is unlikely simply because it's too high a bar to pay to get there.
This call is not straightforward. Skylar, appreciate your input. Skylar Montgomery-Koenig there of Barclays on the US dollar in the next 12 months or so. Normalising interest rates is only one piece of this. Trying to understand White House policy for the next 4 years is almost impossible. Growth differentials and rebalancing growth differentials, I think, is the key point that Skylar's making there. There's nothing convincing happening out of China. Maybe it changes with fiscal policy, don't know. In Europe, there's nothing convincing happening there either. In fact, Europe faces the very real chance that they have to face what we went through in 2022 in this country with technology, but in 2025 they have to do it with autos. And if they go through some kind of auto recession where you have to see all that excess capacity get reconciled, get resolved, get cut, the job cuts that come with that, the outlook for Europe is not great at all.
This is the reason why arguments about debasing the dollar in this sort of dramatic way with central banks moving away from the currency have fallen a little bit hollow. Because what is the alternative to take its place? People could go to gold, people can go to Bitcoin, but the reality is, as far as another major currency, hard to see.
Hard to see, very hard to see. Bit of dollar weakness again on a page on the screen right now. On the S&P 500 equity futures, just about unchanged. Let's call it unchanged. Going into a big week ahead. We've got a Federal Reserve decision on Wednesday. We've got retail sales tomorrow morning and jobless claims on Thursday to look forward to. Looking forward to the next hour of programming on this show. Savita Subramanian of Bank of America, Terry Haynes of Pangea Policy, Michael Harrigan of the Pax Group, and Krishna Mamani of Lafayette College. All of that and more still to come from New York City this morning. Good morning.
It's almost a certainty at this point that we're going to get 3 cuts.
By the time we get to the end of next year, we're probably going to have seen somewhere in the region of 150, 200 basis points of rate cuts.
As we go forward and the cycle begins to ease a bit, that is going to take some pressure off.
The last thing they would want to do is overcut and then be in a tighter predicament.
The risk is if you go 50 first, the market will say, what do you know that I don't?
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now on a 5-day climb on the S&P 500 and struggling to make it day 6. Equity futures just about unchanged, going into a massive week ahead, leaving behind the best week of the year and looking ahead to Wednesday. On Wednesday, a Federal Reserve decision in the mix. It's a 3-part act. You get the decision, the forecast, and the news conference. The day before, though, the economic data, Lisa, retail sales. Can this tip the balance, tip the scales towards 50 versus 25?
You know, last week I would have said absolutely not. We would have already been settled. And right now I'd say absolutely yes. This is going to tip the balance because it's ultimately we haven't been settled in terms of whether the weakness is enough for the Fed to cut. Doesn't matter, though. I keep going back to this Bill Dudley op-ed in Bloomberg, former New York Fed president, where he makes the argument for a 50 basis point rate cut, saying what should it do and what will it do, the Federal Reserve? The answers to these two questions don't necessarily have to be the same, but this time around, I think they will be.
And he talks about the logic of supporting a 50 basis point cut is compelling. My favorite note has to come from Michael Froley, though, saying that what the FOMC will do is less key. What we're sticking with our call, they will do the, quote, right thing and cut 50 basis points. Feels almost like a morality call.
Everyone's got something to say on this decision. Steve Major of HSBC with this to say, for all the talk around the Federal Reserve decision on Wednesday and whether it will be 25 or 50, we really need to know more about where the rate will settle in a year or so from now. You've talked about this repeatedly. What's the destination? What are we playing for here?
They didn't even want to talk, though, about a neutral rate in Jackson Hole. I'm talking about Federal Reserve officials. If they don't want to talk about the neutral rate, how do they speak about a destination when they haven't gotten clarity on exactly what this current economy is? Are they just going to declare victory over inflation over the longer term and say this is a non-inflationary economy akin to pre-pandemic? Or are they going to come out and say neutral rates 3.5%, that's where we're going, see ya.
Can you imagine if they did an ECB, meeting by meeting, and offered no forward guidance whatsoever? Brutal.
That wouldn't work, period. And that, I think, is what a lot of people are saying. They need to provide guidance. Their dot plot will provide guidance. And so then, to Bill Dudley's point, why not go 50 basis points and just say, we're going to cut by 100 basis points. We're going to cut 25 at the next few meetings unless there's some big shock. And we're going to front load it to get there more quickly. And that sort of gets ahead of arguments that might say, if you really thought the destination was 100 basis points lower, why not cut big now?
25 or 50, you will have plenty of arguments. That's just about all we can guarantee this week. If you are just tuning in, a lot of work to get through. On the S&P 500, equity futures just about unchanged. In the bond market, yields going nowhere. We're down to about 364.38. The dollar going somewhere, and that's south. The weakest US dollar of the year so far. Euro dollar at 111. Dollar yen, Lisa, a little bit earlier in the session, a brief break of 140 for the first time in 2024.
I keep going back to this statistic statistics from Kit Jukes. The net longs from CFTC futures have gone to the highest level on the Japanese yen going back to 2016. To me, the whipsaw is just shocking. We went from a massive short position that led to the weakest yen in more than 2 decades to suddenly the biggest long position since 2016. This is a market that is very position driven, and you have to wonder how much that creates these whipsaws that don't create clarity.
Stronger Japanese yen on the screen, 140.08. Coming up this hour, Savita Subramaniam of Bank of America Global Research with a warning for big tech. Michael Harrigan of the Pax Group on the failed assassination attempt on former President Donald Trump, and Krishna Mamani of Lafayette College on the odds for a soft landing. We begin with the big issue on Wall Street. US stocks looking to add to their best week of the year on bets the Fed will kick off the easing cycle on Wednesday. Savita Subramaniam of Bank of America writing, we remain underweight information technology despite arguments it has gotten so beaten up. Tech's concentration risk introduces the risk of passive selling, pressuring mega cap names. Savita's with us around the table. Savita, good morning. It's good to see you.
Good morning. Great to
Got to start with Wednesday, haven't we? 25 or 50. What's the house view?
House view 25, but I mean, I think we're all acknowledging there's risks of 50. I guess the idea is that our view is that the terminal rate settles around 325, 350. So that's what we're sort of tethering our market expectations to. The idea that inflation is cooling, rates are going down, but not to the lows that we saw pre-pandemic, to your point. So we're not going back to that sort of disinflationary environment where you've got, zero interest rates forever. And I think that's what puts pressure on tech and some of these areas of the market that are still very loved and very crowded.
So what should be loved? What should be a little bit more crowded?
I think you want to be in safe dividends. And I know this is the most boring call of all time, but sometimes boring is good. And, when you think about where we are today, we're in an environment where short rates are coming down. Think about all that money that's moved into money market accounts, retirees looking for income, looking for, investments they can live off of. As the Fed cuts, to 3-ish or wherever they settle, that income goes away, but inflation remains high. Retirees need real yield, and where we see that is in utilities, financials, real estate, in the S&P 500, areas that might not seem safe, but today I think they're higher quality than they have been in a very long time.
How did you make that argument last week when we were seeing, in particular in the banking sector, some difficulties?
Some difficulties, yes, indeed. So banks are not, the banks are always taking the hit for anything that's going on that seems bad in the world. But I think right now we are at a point where the yield curve is steepening. You've got the Fed telling us their next move is a cut rather than a hike. We've got an environment where financial services companies have a lot of levers to cut their costs. We've got, I think generative AI is a big kind of transformation story for financial services. For me, I fully expect to be replaced by a bot or a process. I mean, I think this is an area where we haven't seen any efficiency gains in a very long time. And we're now at a point where maybe we're at peak regulation, at least for the SIFIs and the big banks. We've got this new tool that allows us to analyze reams of data very quickly without, having junior analysts sit around overnight. I mean, I think this is a transformation for the sector. So I think there are a lot of arguments for financials, besides the fact that the big banks are the only area that are left to lend. If you think about it, if all these politicians want the economy to keep going, who's left to lend? Private sector, they've picked up the slack and they're starting to show some signs of fraying. Regionals starting to fray. They've picked up a lot of the loan growth. The only area of the U.S. economy that's left to lend are the larger.
Can we speak to Brian directly?
Regulated banks.
I just want to speak to Brian directly. Don't replace Savita with a bot. Don't do that. Is that what you're expecting? Well, I hope that doesn't happen.
Actually, my question was, how many fewer people are they going to end up having? Actually, Deutsche Bank put out this report where they said that they had this proprietary model, ChatDBT, they call it informally, where they put basically the Wall Street Journal and the Financial Times articles in, and then it spit out what the bias was in terms of Fed forecasting.
Exactly.
But it gives a sense of exactly how much these banks are doing with it. I mean, how much do you expect some of these staffs to shrink over the next couple of years?
I mean, I think it's a good thing. I think that we're all going to be more productive. Those of us that are left
going on vacation.
But I think that, like any technology, it replaces some jobs, but it creates new jobs. And it's exciting, right? I mean, when I look at the labor to sales ratio of financial services, it's only gotten worse. Every other sector has mostly gotten more labor light. Financial services has gotten more labor intensive. So I think this is an area that's kind of ripe for cost cutting, for efficiency gains. I think real estate is a really interesting area of the market. We've got dividends, we've got income. When I think about retirees, my dad used to own REITs. Now he owns mega cap tech. I think we're going back to an environment where retirees own REITs, MLPs, yield, utilities, and that's not one of the core holdings of the average retiree's fund at this point.
You haven't mentioned energy, and you say it's gone from value to value trap. Why?
Energy, I worry about a little. I mean, first of all, we're heading into an election where the outcome could be very different in terms of supply, oil supply. Second of all, when you look at CapEx to free cash flow, it's started to creep up. And I think we're in an environment where we want to be buying CapEx takers rather than CapEx spenders. So that's one of the areas where we're seeing free cash flow actually start to come down a bit. We're seeing massive earnings revisions. Our energy team, led by Francisco Blanch, is more negative on oil prices over the next 12 months because of supply and demand. So I think that there's an argument to be made that it's not time to buy energy. Deep value, it might be a little bit too early, but wait and see how the economy shapes up and stick with utilities as your way for getting exposure to commodities.
You mentioned politics. Were you surprised how well fossil fuel companies did under the Biden administration?
No, I mean, I think that this is what's kind of fascinating about energy is that it's done the opposite of what you would expect under each administration, right? I mean, under, the Trump years were actually quite bad for energy stocks. And then, under Biden, we saw energy really rally. I think part of it is just the fact that energy and oil was being assigned a terminal value of 0. Then we realized we're not going to get off of fossil fuels that quickly. There's also this sort of manufacturing renaissance taking place in the U.S. that puts some demand under, commodities and oil. But I think let's say for the short term, I think oil and energy stocks look a little bit risky because the reason they look cheap is that prices have fallen faster than analysts have downgraded their earnings expectations. So that's the sort of classic value trap.
Zooming out, there's a real question about whether this market is fully priced to soft landing and whether the Fed can sort of keep that going, the last gasps of it this week on Wednesday with potentially a 50 basis point cut as well as some sort of forecast. How much can this market kind of rally given the fact, even with a soft landing, given the fact that you don't see big tech as a participant and possibly some of the other high flyers either?
Well, our year-end target is 5,400, which is below where we are today. And I think the idea here is you see some give back in these stocks with high expectations that maybe are going to take a bit longer to deliver. But you do see kind of a re-rating in other areas of the market. So when I look at the landscape of size and style, I think large cap value looks incredibly attractive right now. Because first of all, when you think about where investors are going for income and yield, they're not going to buy small cap value, too risky. Large cap value is banks, it's energy, which we're neutral on, it's real estate, it's companies that haven't really had access to capital for a very long time. And now they're sort of trained to survive in a higher interest rate, higher real rate environment. I think the idea of navigating a soft landing is probably more feasible today because think about where the excess is in the economy. We're not seeing an environment where consumers are sitting on massive levels of debt. Corporations have actually taken advantage of low interest rates and have locked in fixed rated debt. I think we're in an environment where the public capital markets look much higher quality. Maybe the risks have shifted to private lending, areas that are less liquid, real estate. I mean, I worry that if the Fed actually starts cutting and we start to see mortgage rates come down, that reset for home prices might actually be lower rather than higher because we've been stymied by an environment of no price discovery in housing. Nobody's willing to walk away from their mortgages. So it's a weird world, but I think that things could do. We could be in a kind of an opposite environment of the typical easing cycle.
We've got one of those mortgages around this table, so we'll leave that there. I want to finish on utilities.
Yes.
Utilities are up by more than 20% year to date on the S&P 500. You mentioned the sector. It seems like this odd sector where it's everything to everyone. What is this trade? What are we getting into?
Look, I think utilities is sort of the steady Eddie. In fact, we have this chart that that my former boss, Rich Bernstein, used to publish that shows that the total return of the S&P Utilities Index versus the NASDAQ, almost always neck and neck. And it's really the idea that if you get this dividend and you reinvest it in these boring companies, right now maybe they're a little more exciting because of this power AI story, but I think you've still got this sector where you kind of know what's going to happen. They're regulated, they pay a high dividend yield. You reinvest that and you actually do just as well as you would in sexy tech stocks over the long haul. It's kind of an interesting analysis, and I think that's where we see a catch-up over the next few years.
You're certainly doing very well in that sector this year. It's good to see you. I hope you're never replaced. I will not interview the robot, okay? I promise that. Savita Subramaniam there of Bank of America Global Research. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the former president, who was playing golf at the time. People familiar tell us that hedge fund Eisler Capital has lost about 10 money managers in recent days. The departures include people leaving voluntarily and those the firm has dismissed. Returns at the $4 billion hedge fund have been stalling as it attempts to transform itself into a multi-strat fund away from its roots in just macro trading. FX's Shogun broke records at last night's Emmy Awards. The feudal Japan drama won 18 awards in total, including Best Drama and Best Actress. That's the most for a series since 2008. Other winners include Hacks for Best Comedy, overtaking The Bear, and the surprise breakout Baby Reindeer winning Best Limited Series. The Bear, though, didn't leave empty-handed. It won many individual acting awards, including Lisa Colon-Zayas, the first Latina to win Best Supporting Actress in a comedy. And that's your brief, John.
Danny, thank you. Shogun, nothing better. Just like right up there. Just absolutely brilliant.
I couldn't agree more. It's sort of Game of Thrones, just consolidated with more intrigue.
So good. And we get a second season, right?
I know, which I'm really excited about. But Marco's gone. So
I know, I feel
really?
the same way.
Hey, I was like, the show is over.
Yet. No spoilers.
Sorry.
Up next on this program, that wasn't good. Another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been.
Another shocking twist in this campaign in 2024. That conversation just around the corner from New York City. Good morning. This is an apology on behalf of the whole team at Bloomberg Surveillance as Lisa Abramowicz single-handedly ruins Shogun for everyone who hasn't watched it yet. Anything to say?
Including me.
I own it. Sorry. I'm really, come on. It just, I'm so excited.
You relate to it. I guess you just assumed everyone else had seen it.
Exactly. People, if you hadn't seen it already, you already got spoiled. So basically, this is, you're welcome.
Annmarie's sitting around the table thinking, I did not see it. I haven't watched it. And now I'm probably not going to.
Oh, no, I'm already getting hate mail. Sorry, guys.
Sure. Equity futures on the S&P look like this. We're just about unchanged. 5 days of gains on the S&P 500 through Friday, coming into Monday. In the bond market, yields settling down at about 364. In the FX market, the dollar at the weakest levels of 2024. Euro dollar 111.16. Dollar yen around 140. Under surveillance this morning, another attempt on the former president's life.
Former President Donald Trump is safe and unharmed. Following a protective incident shortly before 2 p.m. on Sunday, the U.S. Secret Service personnel opened fire on a gunman located near the property line, and this matter is under investigation. The Secret Service did exactly what they should have done. They provided exactly what the protection should have been, and their agent did a fantastic job.
So here's the latest this morning. The FBI investigating an assassination attempt on former President Donald Trump at his West Palm Beach golf course. Sunday's incident, the second one in 2 months, plunging the 2024 race into further chaos just weeks away from Election Day. Terry Haynes of Pangea Policy joins us now for more. Terry, it's another shocking twist in this campaign in 2024. What does it change, if anything at all?
You know, I don't think it changes anything, John. And sadly, we have some precedent for this. Just about 2 months ago was the attempt on Trump's life. And I said then, and turned out to be right, that I thought that Trump wasn't going to get any lasting benefit out of it. I think that's still true today, largely because Trump has a hard voting ceiling. In other words, everybody that says they're going to vote that's going to vote for Trump is already saying that they're going to vote for Trump. So I don't think this makes much difference.
Terry, when you look at what happened, though, in Pennsylvania, 2 months later, another attempted assassination attempt on the former president's life. And then you have the Palm Beach County Sheriff coming out and saying, well, maybe if there was a bigger protective perimeter, this individual wouldn't have been able to get in. Why is he not being secured as if he is the sitting president? Not saying he is, but being secured on someone who does have these attempts on his life.
Well, I'm not going to pretend to be amateur expert here, but I was involved in a lot of the discussions about the Capitol perimeter after 9/11, but that's another story. I'm still not going to be Mr. Expert here. But Congress needs to get to the bottom of this. And by getting to the bottom, I mean that the relevant people on the committees need to come back. They need to immediately get briefings. They immediately need to figure out what the Secret Service did and didn't do and how to correct it. And they need to do all that within the next week or so. Throwing more money at this problem is not going to help if you can't figure out what the best perimeter is going to be. And Congress has an oversight responsibility that so far it isn't taking up with the alacrity that it needs to.
Do you think this task force is doing a good job, given the fact that it was built on a bipartisan basis from the first assassination attempt?
I'm sure they're getting a lot of briefings. I'm sure they're gathering a lot of evidence. I do think, though, that you get 2 months past the event, you better know all the knowns and be ready to act on it, because we're in the middle of a presidential campaign, and we're in a situation where, heightened security, any incumbent President Biden, whoever the next president is going to need to respond to threats and need to anticipate those threats, apparently better than's been done in the 2 Trump attempts. And, I think the institutions of government here are not acting commensurately with the threat and the peril that's involved here for anybody, not just President Trump.
At this point, when you look going forward, how does this change the narrative, not necessarily for Donald Trump's campaign, but for Kamala Harris's campaign?
Well, I don't think it changes the narrative very much. I do think that at all, frankly, I do think that what ends up happening is that Harris continues to grind it out in the swing states and keep enthusiasm high. If there's any adjustment, I think they maybe adjust a little bit against personal attacks on the president or hyperbolic themes that may overstate his case. I'd bet on at least in a short term, a little subtle adjustment on that. And again, we saw that in July, but then within 2 or 3 weeks afterwards, which turned out to be the Republican convention, everything ramped up as if normal. Those adjustments may last a little bit longer this time.
Terry, given the fact that we have congressmen and women heading back to the Capitol today, what is your expectation in terms of them getting a CR through Congress and keeping the government open till the end of the year?
I'm sorry to say that I think what we'll see is the familiar scenario of brinksmanship, where a very few members see it as in their political advantage or in the party's political advantage to have some sort of performative shutdown. I don't think that lasts long. I don't think it's a big deal. So markets, I think, frankly, ignore it. But underneath, I want to point out to markets, too, that it emphasizes the unseriousness of what's going on in Washington. You have 2 political parties, one of which wants to continue to spend fiscally as it has done. The other political party thinks the idea of bravery is to cut 1% off of 30% of the discretionary funding. Neither is addressing the fiscal debt and deficit problem that markets are increasingly concerned about.
Terry Haynes of Pangea Policy with an important point to end things. Terry, thank you, sir. The important point here really is that whoever is in power, they have a very different view when they're not in power on whether we should be disciplined or not, with the purse strings down in Washington.
Which is the reason why Gary Cohn, who previously was the chief economic council director under Donald Trump, coming out and saying there's very little political appetite to increase the deficit. There's always political appetite to increase the deficit. This is the reason why people are watching when the bond market will push back, because until they do, it's going to be status quo, and that is what it is.
Well, to pick up on Terry's point, what they're fighting in Washington, D.C. is such a small sliver of the pie. This is where all the policy is done. But until they decide to go after what is going on with Social Security and Medicare, there's really no way to fix what's going on fiscally in Washington.
Bond yields this morning, at least, they're falling. They're not climbing. We're down 2 basis points on a 2-year at 3.55. On a 10-year yield, we're down about a single basis point. Your yield at the long end of the curve, 3.64 on 10s. On 30s, just short of 4%. Coming up on this programme, we'll catch up with Michael Harrigan of the Pax Group and formerly of the FBI as federal officials investigate a second attempt on Donald Trump's life. That conversation up next. How much hate mail are you getting?
I'm getting a lot. I'm really sorry. I didn't mean to.
Is it that serious? That sounded so sincere.
Well, it was sincere because I recommend still watch it. Let's move on. I feel really bad.
And there's a second season coming too. Enjoy it. Every futures right now on the S&P 500. Negative by 0.06% on the S&P. We're just a little bit softer on the Nasdaq. We're down 0.4%. The outperformance, just relatively speaking, again, you see it on the small caps. The Russell up by 0.6%. This in from Ian Lincoln of BMO. Odds of 50 basis points are increasing. And they certainly are, going into Wednesday, looking for the first interest rate cut since the pandemic and looking potentially for a 50 basis point move. Switch out the board and get to the bond market. The 2-year yield declining last week in the face of a hotter CPI, a hotter PPI, and not a bad jobless claims data point on Thursday, and yet still, bonds rallied.
Buy the rumor, maybe sell the news, or buy the rumor and then also buy the news, basically. There was this shift, and whether it was a series of articles that came out in the Wall Street Journal and the Financial Times, or whether it was a series of potential officials and former officials who came out in support of 50 basis points of a rate cut on Wednesday. Either way, this is a market almost fully pricing it. They're fully, 40% or a 40 basis point rate cut is now baked in at a time where the data doesn't show weakness, which is basically nirvana for risk assets.
The bias in the bond market is just phenomenal. The bias to buy fixed income every time yields back up. The bias to ignore strength and embrace weakness every time we get data in America. We'll catch up with Manny Roman of PIMCO in about 30 minutes' time on this subject. There is a massive bias to buy bonds in America over the last month.
Without a real question or without a real answer to what the destination actually is. And that really will be the key question on Wednesday. There is an issue of how much bonds can yield at a time where people are racing back to the bottom, even though a lot of people say we're still in an inflationary environment. It isn't necessarily 25 or 50 basis points on Wednesday. It is a question of that neutral rate that they're trying to get back to, and the fact we don't know what it is.
This move in yields unlocking some more dollar weakness. The US dollar started this morning at the weakest levels for the year so far. Dollar yen breaking down to levels we haven't seen since 2023. Dollar yen briefly south of 140. 140.07 on dollar yen. On euro dollar, 111.21. That's some euro strength and a ton of dollar weakness across G10 on the session this morning.
And this is front loading a lot of the rate cuts in addition to maybe a soft landing type of scenario that allows trickling out to other currencies. It also comes with a potential Bank of Japan rate hike. On Friday, there is this issue, though, of how far it can go given the fact that there are a number of economic problems, whether we're talking China or whether we're talking about Europe.
And the outlook for tariffs and policy coming out of the United States. Under surveillance this morning, this story. Donald Trump's running mate, J.D. Vance, saying Trump's plan to hike tariffs on U.S. imports would help offset a growing list of tax cuts. Trump proposing to end taxes on tips, overtime, and Social Security benefits, along with a 10% across-the-board tariff that could spike up to 60% on goods from China.
I have a lot of questions about this, and I go back to what Lori Calvasina said, which is basically I left also the economic speech Trump gave in New York with a lot of questions on exactly his plans for tariffs and when it comes to his tax policies and whether or not the 15% corporate tax rate would benefit all U.S. companies or just those that have some sort of domestic component at home when it comes to manufacturing. But when it comes to tariffs, Trump said this in a Bloomberg Business Week article. He said, man, I'm so confused why so many people are against tariffs. It is good for negotiation. Will this be a blanket, quickly put the walls up around the United States and ring fence the U.S.? Or will this be a negotiating tactic, which Scott Besson told us maybe 2.5% on Chinese goods for 24 months until you get to that 60%?
Annmarie, talking, is there more clarity? I think not on your part, but with respect to policy, the answer is no. There is this issue of, can you really bank on anything from either side to create an economic policy, an economic narrative? And the answer is, for a lot of analysts out there, not so much.
There are many reasons to introduce tariffs. We've talked about so many of them to protect domestic industry. If you want to use them to influence behaviour, this is the question I would be asking people on the campaign trail. What evidence is there that tariffs in America across successive administrations have actually influenced the behaviour of the Chinese, particularly at a time when China is failing to get in line with the Europeans, with the Americans on very key foreign policy issues? The tariffs stayed. Have we actually displayed any success whatsoever in influencing Chinese behaviour? I would suggest very little.
Especially because there have been some backdoor ways for them to avoid them, in particular having to do with the chip sector, in particular having to do with certain technologies in auto manufacturers. The question is going to get a lot more difficult when it's not just blanket tariffs on consumer goods, but when you're talking about some of these high security aspects that recently they're increasing some of their crackdown on.
Should we talk about one of those loopholes? I had no idea this even existed. White House officials poised to crack down on a loophole, allowing low-cost goods to be imported from China tax-free. The US planning to begin taxing packages worth less than the previous limit of $800, a move directed at the rise of bargain shippers like Alibaba, Temu and Shein. I didn't know there was this loophole, but there you go.
To me, again, I was shocked that there was this loophole, and why does it exist? And I have to say, as much as some people, even in my own household, have gone to some of these and even gone to different knockoff brands to try to knock off some of the luxury players for cheaper goods from China, as much as they might lose out here, why is this in existence? Will this be difficult for them to get through at a time where it seems like a no-brainer? It just highlights, going back to the point we were making earlier, we say whether these tariffs have been effective, what are these crackdowns? There still are so many different apparatuses in place to make it easier for Chinese manufacturers selling into the U.S.
The reason why you guys don't know this exists is because you're not targeted by these cheap products, by Shein, especially in the fashion world, because you're not on TikTok, you're not on Instagram, and this is where they are starting to pick up these teens that want fast fashion at a really reasonable price.
That's why we're not shopping on Temu. No TikTok account. That would change.
Evidently. I'd be a lot hipper if I had a TikTok account, evidently.
Possibly. Lisa's still apologising, by the way, for those of you just tuning in for completely spoiling the show.
Oh, my God. Are we going to do this all morning? Just keep bringing it up again and again?
You ruined it
Possibly.
for me.
Okay.
Possibly. Let's turn to a much more important story. The FBI is investigating a second assassination attempt on Donald Trump at his golf club in West Palm Beach, Florida. Secret Service agents reportedly spotting a rifle barrel sticking out of a fence before opening fire and apprehending a 58-year-old suspect who is now still in custody. Joining us is Michael Harrigan of the Pax Group, who is also a retired FBI Farms Training Chief. Michael, welcome back to the programme. I'm happy to catch up with you, sir. Unhappy to be speaking about the same subject again just 2 months later. Michael, just tell us from your perspective why it's proving so difficult to secure and provide security for the former president.
Well, Mr. Trump, he moves around as he likes. I mean, obviously he's under Secret Service protection, but, he likes to get out there. He's known to love golf, outdoor venue. I think what you have here is you have to look at each threat and each attempt independently and look at what the background of these are. And both seem to be where there was some planning, and it was a point where he was vulnerable at that moment. So it's a tough one here to have two so close to each other, or should I say two on one candidate. That's unheard of. And this points to a very high threat level for the former president, and one that may call for rethinking his security and for Mr. Trump potentially to rethink how he goes about his daily life.
Well, Michael, that's what I wanted to ask. When you look at the near term right now and protecting the president, is it about changing his schedule or potentially changing some of his habits and what he likes to do? Or is it about changing the Secret Service?
You know, it's a two-sided knife there. Both sides have to be assessed. But, you know, when you come down to it, if you're not the number one thing for vulnerability, if you're not available to be attacked, that's your primary defensive measure, not to be where you could be attacked. Now, the Secret Service, again, they took a very hard look at them. You know, Congress and American people have been asking questions about Secret Service since the Butler incident. On this situation, though, we don't know enough yet. It sounds, from what we can see, is that the Secret Service performed phenomenally in interdicting this threat before the man could take the shot or take an effective shot at the president. So Secret Service did well here. But I think you have to look at the overall structure of where he was, a public street. Anybody can stop a car and jump out anytime. This guy obviously crawled into the bushes where he was concealed. So, you know, I think that both sides have to be looked at. But I think the primary thing here is for Mr. Trump to consider changes to his schedule now, however uncomfortable he might find that to be, and remove himself as a potential target of.
Well, this individual is 300 to 500 yards away from Trump while he was golfing. And the Palm Beach County Sheriff said yesterday that if Trump was the sitting president, we would have had this entire golf course surrounded. Should they have done that? Should they start expanding the perimeter?
Well, I think it's a duality here, again, is that, Secret Service has to obviously make some changes in how they might protect him if he's on a golf course. And I can guarantee you that from this point forward, he's not going to be in this position on a golf course. Secret Service is going to step up and do what's needed. But, you know, you look at the balancing the public inconvenience of shutting down those major roads there in that area. To shut those down while he's playing golf is a huge inconvenience to the public. Obviously, in light of this situation, a reasonable cost to be paid, though, a reasonable cost. So, you know, both sides have to be looked at. And, frankly, Mr. Trump may have to listen closer to his Secret Service advisors there and just make those changes, at least in the lead up to the election. It's only a couple months away. Obviously, he's got to get out there and go to his rallies and engage with the American public. That's what he enjoys doing. So that can't be interfered with. And they are taking very good measures there when he's in public at official events. But it's these private events like this where he's so-called off duty on his own time that now we see how vulnerable that can be. And it's a lesson to other presidential candidates out there for them to reassess how they go about their personal lives. It's a very frustrating time in this country to see this happening. And it's a critical time for us to maybe make some changes.
Given your prior work at the FBI, do you think this individual was watched, that given the fact that he, according to his Twitter account, which has now been shut down, has gone over to Ukraine and he claimed he was fighting on behalf of the Ukrainians? Was this individual, do you think, flagged previously by the FBI?
You know, he could have been, but when you look at the breadth and depth of people that travel overseas or may have political views, I mean, it's a staggering amount of persons that could be potentially looked at by the FBI and maybe a file opened on them. Nothing substantive can be found because it's simply First Amendment speech. So then it's moved on, and they move on to other more relevant, more current threats. So just the fact he traveled overseas probably isn't a point of the Bureau looking at him. It would be more of what he's saying and what his footprint is on social media and what he said maybe to, in the public arena in other ways, whether he's a threat or not.
Michael, just to go back 2 months,
to Ukraine.
If I can jump in, sir, if you don't mind.
Yes.
Are you surprised
Absolutely.
how little we know about the motive behind the first assassination attempt only 2 months ago and the lack of detail between then and now? Are you surprised by how slow this process seems to be going?
To a point, I mean, I think the primary point here is to find out if both these individuals had connections to a foreign government, to a larger conspiracy. But unfortunately, what you see in some of these, what we call lone wolf actors here, that act on their own motivation, they may have minimal communication with others that could become a red flag and a chance to report and interdict these threats. So these individuals are out there. It's the same with the individual that shot at the Republican congressman on the Hill. He wasn't able to be interdicted beforehand because he was a lone wolf. He was on his own, decided to do this on his own. And same with these. Very difficult if they're not having conversations with others and talking about their plans, you lose that opportunity. Or if they're part of a conspiracy or a group that's under surveillance by the government, then the government has the opportunity to look at those communications and potentially stop these threats before they materialize.
Michael, we hope we don't have to have this conversation again. Michael, thank you, sir. Michael Harrigan of the Pax Group and formerly of the FBI after a second attempt on the former president's life in just 2 months. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The yen is around its strongest level in over a year. The currency appreciating for a fifth consecutive day. It did briefly fall below 140 versus the dollar this morning, but is now back just about at 140. This morning, it's mostly the dollar side moving on nearly even odds for a 50 basis point cut priced into markets. The Fed's decision comes Wednesday. The BOJ's on Friday. Intel shares higher pre-market by over 1%. People familiar telling us that the chip maker has officially qualified for as much as a $3.5 billion in a federal grant to make semiconductors for the Pentagon. That would add to a possible $19.5 billion in grants and loans awarded to Intel through the Chip and Sciences Act. As of the Friday close, the stock has fallen some 61% this year. Now, those $8 lattes may become more commonplace. The cost of premium Arabica beans this morning surged to the highest level in 13 years. Coffee futures as a whole have surged around 40% this year. There's been shortages of the cheaper Robusta beans, and that's boosted demand for the premium Arabica variety favored by coffee buffs. There's been concerns also about harsh weather in Brazil that's fueled the rally. Brazil currently grappling with its worst drought in decades. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Two views, two very different takes. Earlier on this morning, the former New York Fed president, Bill Dudley, making the case on Bloomberg Opinion the Fed should go big now. I think it will. Moments ago, Steve Englander of Standard Chartered, good reasons not to cut by 50 basis points. This one, I keep saying this, it is so finely balanced going into Wednesday.
And a real question of whether it matters ultimately, given the destination, how much they can telegraph that, given they will have a dot plot, they will have a statement of economic projections.
Up next on this program, a split decision.
We're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut, it suggests to us that they're more worried about downside risks to the economy.
That conversation around the corner from New York. You're watching Bloomberg TV. You're going to get this all week. This from Steve Englander of Standard Chartered. Good reasons not to cut by 50 basis points. The economic data has not made a compelling case for a 50 basis point cut at the upcoming meeting. Goes on to say cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. What do you make of that argument?
It's arguably the exact opposite from what a lot of people are arguing. So you can pick the argument you like. You can make an argument either way. Problem for me is how much does it matter if you do understand the path, if you do understand how much they're going to cut this year? But then the second question is, if you think that 50 basis points of a cut is going to be the bigger mistake, does that mean that you think that inflation is still very much a risk, lurking beneath the surface, ready to rear its head once more?
You'd have to imagine that's what he means by being wrong. You'd have to imagine that might come up on the FOMC in the debate over the next 48 hours or so. Equity futures right now unchanged. Going into all of this on the S&P 500. In the bond market, down almost a basis point. The 10-year 364. And in the FX market, as we've said all morning, the dollar near the lows of 2024. Euro dollar 111.23. Under surveillance this morning, a split decision.
The Federal Reserve should be focused on moving policy rates back to neutral. And I think the question at this point is just how quickly they get there. We think they probably will revise down their own estimates for the rate path. In September, we're looking for a 25 basis point rate cut, but for them to really signal they're going to do a sequence of cuts here. A 50 basis point cut is if they end up doing it, it suggests to us that they're more worried about downside risks to the economy.
So here's the latest. Treasury's gaining with all eyes on Wednesday's Fed meeting. The debate on Wall Street now 25 versus 50. Christian Mamani preach. I hope they trot somebody out. Set us up for a 50 and relieve us of our misery ahead of the meeting. Somehow I don't think it's likely. If we're going to have a hard landing, 50 won't stop it. It is too late for that. Krishna joins us now for more. Krishna, I just agree with you, sir. I think we all do. This is getting tedious. This from Steve Englander, and I want your thoughts on this, and welcome to the show. Cutting by 50 and being wrong would likely be worse than cutting by 25 and being wrong. Krishna, what do you make of that logic? Do you agree?
Well, so I think the point Steve is not articulating is the fact that the Fed is bound by its mistake in 2021. That is, in their minds, if they cut by 50 and you have reacceleration, that's a bigger challenge than if you have if they cut by 25 and things continue to slow down, because they believe they have a lot more space to cut rates over the next 12 to 18 months. However, if there's a reacceleration, it's on them altogether. So I think that's what the Fed is dealing with rather than the economic reality.
So what is the economic reality, Krishna? I mean, this has sort of been the big mystery. You said that ultimately is really what's going to be at stake in terms of determining the path of risk assets.
Yeah, so I think Dudley today articulated the economic reality quite well, which is, look, growth today is quite decent, 2.5% GDP now. Inflation has come down. Relative to inflation, short rates are too high. They can cut 50 basis points. Whether they will or not is really the issue. Is there enough room in the rate structure today for them to be aggressive? And absolutely. Is there weakness enough for them to kind of go whole hog? Absolutely not. And I think that's the challenge that they're dealing with.
What does whole hog mean, though, Krishna? I guess that's really the key question, given the fact that people are saying, some people are saying 50 basis points would move the needle on what market expectations were for the full year. Bill Dudley's argument is if you think that neutral is substantially lower than where we are now, why not get a rapid start to it? Otherwise, why aren't people going to ask, if you think neutral is 150 to 200 basis points below where we are now, why not move a little bit faster to get there?
Oh, absolutely. I think, again, they have the room to move faster. However, I think, as Dudley also argues, is the fact that they got a head fake in early part of this year. And they don't want those head fakes because that would, doing a 50 ahead of an election, then end up with the head fake would probably be far worse for the credibility of the Fed than anything else. But as you have been articulating, that's really besides the point. I think they will articulate a very aggressive rate cutting path. And I think in the end, that probably matters a whole hell of a lot more than anything else. What we are dealing with is a situation where inflation is coming down, rates are high, economy is doing reasonably well. So there's a negativity vacuum, and we are trying to create some drama in the middle of all of this.
So, Krishna, let's get the market call. Let's think about how far bonds have moved. The 2-year topped out just north of 5% earlier on this year. I think back in spring, back in April, we've had a move of about 150 basis points lower at the front end since then. We've had a round trip in equities. Call it a growth scare, call it August, whatever you want to call August. We're back close to all-time highs on the S&P 500. Krishna, given those moves, as you start to think about the balance of risks into year end, more upside risks or downside risks? What is the bigger risk for you?
So I think as far as bonds are concerned, at these levels, unless you think we are really going to have a recession or that probability goes up, I think the upside, that is lower yield upside in bonds is limited in my judgment. And it's not that we are probably going up meaningfully higher. It's just that we just sit around here for a long period of time. Having said that, I think if actually probability of recession increases, and we won't find out till probably middle of 2025 whether that is the reality or not, rates can move very, very substantially. I think the challenge with equities is the valuation. The environment is right, but environment is right along with the fact that we have already incorporated all of that information in our pricing. So upside is limited there as well, and a recession, the downside is quite substantial.
So what does that mean you're doing, Krishna?
I'm sitting tight from a risk perspective, and has been the case for a few months. Hasn't worked out too badly with the special emphasis on bonds. That is, if you had some spare money, investing in bonds makes more sense because it can run away from you. Equity markets are not going to run away from you.
Krishna, just quickly, invest where in bonds?
Invest in the short end of the market. I think you'll be still cash is yielding pretty good, then at this pace, it'll yield pretty good for a reasonably long period of time. And if you don't, if your expectation is that we are going to have a soft landing, which is the case for me, the upside in buying longer bonds just doesn't exist anymore.
OK, Krishna, thank you, sir. Appreciate your input. Good luck for the rest of the week. Try and get through it. Krishna Mamani of Lafayette College. I think we all feel the same. Peter Cheer feels the same too over at Academy. Good luck. I wish the Fed would come out at 10 a.m. Eastern time so we'd have less time to second-guess every position and view.
Basically, we're all sick of this conversation, and yet we're going to be having it for the next 48 hours. I do want to just note that what Krishna just said there was not what a lot of fund managers want to be hearing. You know, stay in money markets.
They've got things to sell.
I mean, they've got things to sell, and this isn't working for them.
If you find this tedious, wait until the next one. November 7th, that's going to be quite a meeting for the FOMC, 2 days after the general election.
Yeah, I don't know that that's going to be tedious, though, because they're going to have to take a look at who won the election and what the economic projections most likely are going to be at a time where that also is an uncertainty vacuum. I mean, a negativity vacuum. I love that idea. I hope we stay in a negativity vacuum for a while.
hope we know who won the election 2 days after the election. That might be wishful thinking.
It might be wishful thinking because some of these states cannot start counting their mail-in ballots, notably Pennsylvania, until the election is over on November 5th. So it might take a few days.
Coming up on this programme, here's a lineup for you for the third hour of Bloomberg Surveillance. Manny Roman of PIMCO, don't miss that. Greg Dacko of EY, Megan Robson of BNP Paribas and Bloomberg's Ira Jersey. It's a big week ahead. The third hour of Bloomberg Surveillance up next.
There is a real risk the Fed is falling behind the curve here.
This Fed tends to move slow. They're watching with a rearview mirror.
The recent loosening in labor markets just suggests that there is some possibility for overshooting.
It's now about next year and the year thereafter where there's much more uncertainty.
It's not just that we don't know what the destination is. We don't know what the journey is.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now with an absolutely fantastic lineup for you. Equity futures on the S&P 500 just about unchanged, coming off the back of a 5-day winning streak and involving the most tedious debate of the year so far. It's become tedious, that's for sure. 25 or 50 at the Federal Reserve on Wednesday.
The reason why this is so tedious, let's examine the tedium that we have to discuss for the next 48 hours, is because we also don't know how much it will matter. Because ultimately, it is not just about 25 or 50. It is about how the market responds to it. It is about how it is telegraphed going forward. It is about the destination. It is about how Jay Powell dresses and how he sort of intonates when he gets to the press conference.
He used to do that with Draghi ties. Do you remember that? Yeah, and then it became Lagarde scarves and stuff like that. Just ludicrous stuff. Things are so finely balanced. There is a real belief on the street right now that a soft retail sales print or a firm one could tip the scales in one direction or the next. We've got retail sales tomorrow morning, and then we've got jobless claims on Thursday. Is that going to be what tips the balance here into Wednesday?
Well, it's because the market was pricing in 25 basis points after the jobs report, after inflation, and now all of a sudden, after an FT, a Wall Street Journal article, and we should note Bill Dudley's comments and an article in Bloomberg Opinion, now the market is pricing in 50 basis points. Potentially the next shoe to drop where they can maybe change their position will be retail sales.
The former New York Fed president making a case in Bloomberg Opinion to go big, and he thinks they will. It's not just a case to go big. It's that he thinks they will go big on Wednesday afternoon.
He cited the articles in the Wall Street Journal and the Financial Times as a good sort of sense of how the debate was evolving, talking about how they could avoid getting criticized for not getting to the destination more quickly if they went by 50 basis points. If you take a step back, it goes to this question of what is the bigger risk here, inflation or employment? Pretty much everyone thinks that right now, at the moment, it is economic weakness or economic potential softening. On the flip side, Neil Richardson talking about what we see in housing prices, what we see with household wealth, what we see with sentiment. It's sort of tricky to know.
At the moment right now, there is a belief that it's more likely we get 50 than 25 based on market pricing. Coming up this hour, this is the lineup for you. Manny Roman of PIMCO. As markets await this week's Fed decision, we'll catch up with Greg Dacko of EY on why he's expecting 75 basis points of cuts before year end. And we'll speak to Megan Robson of BNP Paribas on why she's bearish on credit, going into the election. We begin with a big issue on Wall Street, 25 or 50. Bond yields falling going into this week's finely balanced central bank meeting. The PIMCO team writing the post-pandemic inflation shock and rate hiking cycle produced a generational reset in bond yields. Central banks have largely succeeded in bringing down inflation to 2-point-something and are poised to begin cutting rates, creating a compelling multi-year outlook for global fixed income. I'm pleased to say that the boss over at PIMCO, Manny Roman, joins us now for the next 30 minutes or so. Manny, it's good to see you, sir.
Good to see you.
Good
Thank you for having me.
Put us out of our misery, 25 or 50 tomorrow. What's it going to be?
Well, we're in the camp of 25, but I always say we have a crystal ball, and at the end of the day, we'll see what the market does. It may very well be that it doesn't make that much of a difference, and our view is that there will be 3 cuts of 25. And at the end of the day, what matters is where we are at the end of the year.
Well, let's talk about the destination. This is a 3-part act on Wednesday, as you know. It's a decision, it's a set of forecasts, and a news conference, and a big conversation around this table for the last several months. What's the destination? What are they aiming for? What are they shooting for? Where does this land in the next 18 months?
Well, I think you can say that there's less inflation right now, and that in the absence of new data, the destination will be to have lower rates, and that the Fed will be very data dependent. And I think sometimes one underestimate how careful they are about new data and how they want to be able to change their opinion. And so if you kind of use this framework, you sort of say, let's do 25 and then let's see where we are, and then probably do 25 and 25. But I think the total sum of the rate cuts may matter more than how they do it.
Which is the reason why people are looking forward and saying maybe the neutral rate's 3.5%. And oh yeah, look at that. The 2-year yield right now is about 3.5%. Back in June, when you put out the outlook for PIMCO, there was a feeling that intermediate bonds really had a fantastic investment proposition just simply because there was yield. Do they still, after the rally we've seen?
We still do think so. And listen, the exciting thing about being at PIMCO right now is that fixed income is quite attractive. And we are in a business of feast and famine, right? So when rates are very, very low, it's harder to be that excited about fixed income. And when you can build portfolio and get a yield of 6.5, you become very excited. And we're very focused on treasury. But the reality is there is a lot of value in other part of the segment, asset-backed being one of them. And, we're excited about what we see, and at the end of the day, the yield on the portfolio is a good predictor of the return that the investor will experience. And so what I think is exciting about fixed income right now is you can build a portfolio and get a return of 6.5% with a series of different instruments.
It used to be that bonds did better in bad times and worse in good times. Are we heading into a worse time where people go to bonds for safety, or is this on just an absolute basis, yields are higher?
My partner Dan Iverson, and I'm going to quote him because actually he has a very good line. Bonds may be the most attractive asset class. And I think that there's an absolute argument and then there's a relative argument. And I think the relative argument is to say you need to build a portfolio, you need equity, you need fixed income, you need some real estate, you need some private asset. And at the end of the day, fixed income is much more attractive than equity given the earning yield and given the valuation of the equity market. And I think that's one of the arguments for owning a larger part of fixed income. And I think when I travel the world, I think that people are underinvested in fixed income. And a lot of them are looking at putting more money into fixed income. And whether they do it tomorrow, whether they do it 2 weeks from now or 2 months from now, I don't know. But the reality is people were underinvested various parts of the fixed income market, and they're looking to readjust their allocation.
Have you got confidence we've re-established the inverse correlation between bonds and stocks?
I don't know what I don't know. And I think correlation fluctuates over time. I think that fixed income have a role in a portfolio construction, and I think they're there for a reason. But of course, credit spread in the high yield market are correlated to equity prices. So once again, I think one needs to be careful about how you frame the question and how you conclude.
Well, I guess I would be more specific by saying, have treasuries re-established an inverse correlation with equities? Because one of the risks that we've seen established over the last few years, particularly given the central focus was inflation, is that when bonds sold off, equities did too. Have we changed that story? Have we left that behind?
Hopefully we have. But I think remember that we also saw with the pandemic really an unprecedented program of money creation, which sort of threw everything and our economic textbook in terms of how we thought about the correlation. And so I'm careful about what I say because the data are just so skewed in terms of what we saw. And I think, you can make the argument, for example, that part of the reason why the US economy has done so much better than any other places is that the package in terms of the pandemic has been so much bigger than in other country. And at the end of the day, all you can do is cross-sectional analysis and try to compare different countries, but there's so many other variables that comes into the picture that you don't want to understate the enormous creation of great company in the US versus Europe, for example. And so I think we try to always be careful about making definitive conclusion when it comes to correlation and when it comes to cross-sectional comparison between different countries.
Another way to frame this question is when you travel the world and you talk to international clients who are underinvested in fixed income in the United States, how many of them turn to you and say, what about the US deficit?
Well, my friend and partner, Richard Clarida, used this very American expression and says the U.S. is, let me try to make sure I get that right.
Carry on.
The cleanest dirty shirt. And, we have debated quite a bit at a forum about deficit and deficit do matter. And they do matter. And at some point in time, there's a tipping point, but we're not there. And the reality is it's a huge competitive advantage to be the reserve currency. People need to own dollars. And the reality is we don't think there's a crisis coming and that the US can have certainly a high level of debt versus historical precedent and be able to function just fine.
When will the US get there? And do you see either party have any impetus to try to rein in spending?
So to quote my partner once again, Libby Cantrell, who comes often here on the show, no, we see no impetus to try to deal with the budget deficit. The only real example we have is the United Kingdom. And I think that the United Kingdom was actually quite interesting because you saw a situation where the bond market reacted so violently to the Liz Truss proposal that all of a sudden they had to change really, really quickly. And I think that this example of what happened in a very developed country and how the Bank of England reacted really quickly with the LDI situation and the pressure in the gilt market and in the pension market will be a textbook example of why markets react quite strongly when something outrageous comes.
Well, we have a Bloomberg survey to that point that says Kamala Harris, a victory for her in the White House would be better for treasuries and worse for stocks, vice versa for the former president. Would you agree with that scenario analysis?
I think there's so many unknown. It depends on what happened in the House. It depends on what the winner can do in terms of program, how this is all going to pan out. I would be very careful about making any prognosis on this matter. I think when we think about the world, I realize politics is really important.
Yeah.
But at the end of the day, that's not how we invest. We invest because we find value and we find opportunity and we try to buy cheap and we try to manage portfolio and think about risk carefully and ride different cycle and deal with many other factors than politics. And there's a few exceptions. If you talk to my partner Pramal Dawan in emerging market, all of a sudden, in emerging markets, sometimes politics do really matter because they are very big changes and very big different outcomes.
The struggle, Manny, as you know, is that some DMs have traded like EMs over the last few years. And you mentioned the UK, so I won't put words in your mouth. I do want your views. Well, it does feel like a self-imposed debt break in the United Kingdom. And I'm wondering whether, from your perspective, for you and the team, that actually makes UK government debt a little bit more attractive here.
We think it's very attractive. We like the UK, we like Australia. We think that the UK fits very well in the portfolio and they will need to cut rates significantly. And so when you think of a global outlook, the UK looks good for a fixed income investor.
Relative to the United States, say, in terms of duration risk?
Relative to other countries in Europe, certainly compared to European bonds. We also like the US. So, if I want to kind of sum up things, we like the US, we like the UK, we like Australia.
OK. Manny, you're going to stick with us, I'm pleased to say. We're going to have more to say on both the markets and on the industry as well. Manny Roman of PIMCO sticking with us for the next 20 minutes or so. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Donald Trump is reportedly safe and well after a second apparent assassination attempt. Authorities took a 58-year-old man into custody at Trump's golf course in West Palm Beach, Florida. Secret Service agents had spotted an AK-style rifle barrel sticking out of a fence about 400 yards away from the president, who was playing golf at the time. The FT reporting this morning that Citi is stripping its chief operating officer, Arnand Selva, of his responsibility for a key piece of its compliance work. Citing 4 people familiar, the paper said the change follows a $136 million fine by regulators this summer for reporting failures. Selva's responsibility for data compliance will instead be passed to the bank's chief technology officer. And a new report finds that New York City's MTA transit system needs $115 billion of repairs and upgrades. The Citizens Budget Commission says the city should focus on repairing its current infrastructure rather than diving into expansion projects. The estimate, though, far exceeds available funding. The MTA must release its 2025 to 29 budget by October 1st. And that's your brief. John.
Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, we'll get you some morning calls, and later, Greg Dacko of EY weighing in on the 25 or 50 debate. Greg's coming up a little bit later in the programme. More from Manny Roman of PIMCO. Up next on the show from New York, this is Bloomberg. The opening bout just around the corner. Equity futures turning a little bit lower on the S&P 500, negative by 0.1%, coming off the back of a 5-day winning streak on the S&P and the best week so far of the year. Time now for some morning calls. First up, Wells Fargo downgrading Colgate to underweight, highlighting the stock's rich valuation and slowing sales growth. That stock is down 1.6%. Your second call from B of A, initiating coverage of Yelp with an underperform rating, expecting competitive pressure to weigh on the growth outlook. And finally, Evercore, cutting its price target on Alphabet to 200, down from 225. The analysts seeing limited upside due to lingering antitrust concerns. That name is just about unchanged in early trading. Back with us around the table, I'm pleased to say, still with us is Manny Roman of PIMCO. Manny, I want to come back to the bond market and just talk about a dynamic that started to really take hold over the last month or so. The 2-year, 10-year segment of the yield curve, things just starting to normalise. Bit of steepness, almost back to double figures this morning. As we get that curve normalisation, can you walk me through how much things change in fixed income, whether you're starting to see that cash deployed a little bit more?
Well, I think there's that. And of course, people kind of look at the cash they have on the sideline, and there's about $10 trillion of money in cash where they will think to reinvest it, either by extending duration or by going longer or by taking a bit more credit risk. So there is a wall of money out there. And I keep on saying this. And of course, some of it is cash corporate and will remain cash corporate. But I think people have been very much on the sideline rolling short-term treasury bill. And this money will get redeployed. And how fast and how remains to be seen. The other thing which I think you may find interesting is there are a lot of opportunity in relative value in the fixed income market, and in particular, think of Japan. You know, nothing happened in Japan for 15 years, and then all of a sudden, we now have positive rates in Japan. And there's a lot of arbitrage to be done. It's across the curve, it's with swap, it's with different instruments, and all of a sudden, there are sources of alpha, as we tend to call them, where basically they didn't exist 2 years ago, which have come back to the market in spade. How long it lasts, we'll find out, but it should be a very exciting opportunity in terms of the whole market, in terms of delivering better performance.
How difficult is it to pry that cash out of people's cold hands, given the fact that people really do like what they're getting? And, oh, by the way, there are 15 other fund managers out there also trying to get them to pry that cash out of their hands.
Well, I will tell you, competition is good for everybody. And at the end of the day, there's two things. There is, when the Fed cuts rate, eventually the short end of the curve becomes less attractive, and I think you'll see cash moving. And from a competitive standpoint, we want to do the best possible job in terms of being a fiduciary and doing a good job in terms of performance and being there for our clients. And we compete every single day. And hopefully we win more than we lose. But all we can do is try our best, and we're trying very hard.
Where's the edge? Where's the sort of growth concentrated in, or is trying to be concentrated with respect to PIMCO in the, say, 5 years ahead?
Well, Asia has been quite exciting lately, and there's a lot of things happening in Asia. And you can sort of think of our business as being linked to GDP in terms of the saving rates, and people, when they save more, invest more. And so Asia has been quite exciting. And the US is an absolutely wonderful place. I mean, it's a big market, and there's a lot to be done. We have a very good Canadian business. We have a very good Latin American business. There's a lot of good things happening. But the one variable we don't control is, of course, the macroeconomic situation. And so if you have a real reversal and you have, for example, a recession, and let me just say it's not our scenario, but if you have a real recession, people become more risk averse and take some money away. And at the end of the day, we're here for the next 20 years, not for the next 20 minutes. And so, we have very liquid portfolio. People can take their money whenever they feel like and reinvest and so on. And we understand that people need money for all sorts of reasons.
There are a number of behemoth asset managers. PIMCO oversees $1.8 trillion. How much bigger could you see it getting?
It's all about performance. And I always say the great thing about not being public and not having to give quarterly earnings is you focus on what matters. The circle of truth is if you perform, they will come.
You said this last time we spoke. Don't measure our success by assets. We measure our success by the returns we provide. Does it disappoint you? Is it slightly upsetting that people do measure your success by assets? Because they've been pretty stable now for the last decade. BlackRock over the same period has multiplied. Is that disappointing to you that people judge you by that?
I think we have a very different business model. And, we were talking about Walmart. We don't want to be Walmart. Walmart is a fantastic company, but we have an opportunity set where we very carefully think about capacity and how much money we can put to work and what the right target return are for investors. And I think that, by definition, means that we won't be the largest asset manager, and so be it.
When it comes to asset management, private markets comes up all the time, and everyone's trying to make their own push. Where does PIMCO fit into that big push at the moment into private markets?
So we try to focus on what we know how to do. And what we know how to do is fixed income, and so that includes, as a matter of fact, everything which has to do with private market and fixed income, and it also involves real estate. And there's a big real estate cycle that should be exciting. There will be pieces to pick, and there will be cheap investment, both in debt and in equity. And in the private credit market, there's quite a unique opportunity in asset-backed lending. That's where my friend Dan Iverson grew up in. We have been doing this for 20 years. And the one thing which has changed, so to speak, is the banks need to free up capital. And so they need to sell large portfolio of many different assets and do it fairly quickly. That's an opportunity for us. And so if they are good entry point and good asset to pick, we should be able to do quite well.
What types of assets? Are you talking about commercial, or are you going to be owning loans, big residential
mortgage,
swaths?
All bonds
rental
that
homes?
Banks... Let me just focus first on fixed income. I think in fixed income, there's a lot to buy. And there's a lot to buy because the banks need to delever. And so the banks, you can think about what they have on their balance sheet. They have loans that they've given to company and they want to get rid of it. And so they sell it to us. And that, I think, is fairly straightforward. In real estate, you have a real estate cycle and there will be different things you can do. Some will need pref equity, some will need debt, some will need to buy equity. And we just need to make sure that it's cheap enough and that we think carefully about what happens and make sure we have an expected return which compensates for the risk. And it needs to be high because there's a lot of risk in commercial real estate, for example. But we had a pretty fast cycle and hopefully we're going to be on the right side of the trade coming out of it.
We've only got 60 seconds left with you. So the hardest question of the morning. What's more likely? Arsenal winning the title or the Federal Reserve engineering a soft landing?
Arsenal winning the title.
Arsenal winning the title.
Yes.
Should I read into anything about your real views on the economy then, based on that, or you just think Arsenal's that good?
No, you should. You should think about Arsenal. No, I think. Look. I think people are very. Sometimes criticize the Fed. I think they do a really, really good job with a very difficult hand to play. And they don't know what they don't know at the end of the day. And I think it has been a tremendously complicated market to navigate for everybody over the past 4 years. None of us ever thought we would see a pandemic. And, from an investment standpoint and from a regulatory standpoint and from the Fed standpoint, I think we had to learn a new playbook.
It's been humbling for us all. Manny, it's good to see you. And great win over the weekend. Thank you, sir. Appreciate it. Manny Roman there of PIMCO. Coming up on this programme, Greg Dacko of EY and Megan Robson of BNP Paribas. The week continues to build. The anticipation continues to grow. 25 or 50 on Wednesday. A three-part act. A decision. A set of forecasts from the Federal Reserve and a news conference with Chairman Powell. Going into all of that, a 5-day winning streak on the S&P 500. 1 hour away from the opening bell, with equity futures down just 0.1%. And in the bond market, yields lower by 2 basis points, with the dollar sitting near the lows of the year so far. Euro dollar, 111.27 from New York. This is Bloomberg. It's Monday, 8:30 Eastern Time, and I know you're already absolutely sick to death of this, but it's going to continue for the next 48 hours. This from Andrew Holmhorst of Citi. 25 or 50. Don't turn the volume down. Stick with me. This is what he's got to say. Our base case is a 25 basis point cut on Wednesday, but articles in the Wall Street Journal and FT last week left the potential of a larger size cut on the table. This will come down to committee dynamics, arguing for the next 2 days, and Tuesday's retail sales report. In either case, we expect a dovish FOMC, with the median dot for this year implying 100 basis points of cuts, which would mean at least one 50 basis point cut at one of the next 3 meetings going into year end. Going into all of that and going into the opening bell, which is about 60 minutes away, your cash open is just around the corner, and equity futures are down by 0.1% on the S&P. On the Nasdaq, we're down 0.5%. On the Russell, some outperformance. The small caps up by 0.4, coming off the back of the biggest weekly gain on the S&P 500 so far. Let's get some morning movers with Danny Berger. Hey, Danny.
Hey, John. A little bit of sell-side action this morning. Colgate palm oil down some 1.5%. This coming from Chris Carey over at Wells Fargo, downgrading from neutral to underweight, saying that it's not weakness, it's just normalization, that the epic run for Colgate is over. Also doesn't help that there's been this huge defensive equity run that has left the stock more expensive than their peers. Meanwhile, over at Intel, it is a gain in the pre-market session this morning, up 1.5%. Bloomberg reporting on Friday that they have won a $3.5 billion defensive contract for the Pentagon to make chips for them. There's been some criticism from their peers saying that the White House, that the Pentagon is just too reliant on this one chip company that has had some issues. That's down 60% year to date. Nevertheless, shares up 1.4%. Wrapping things up with Apple, shares down 2.5%. Strategist Min-Chin Kuo saying that they've done pre-market checks, they've looked at supply chains, and the orders for iPhone 16 are weaker than anticipated. John, 13% down year over year versus the iPhone 15. It's because of competition in China, and that Apple Intelligence, that AI feature, you're not going to be able to get it with this iPhone 16 latest release.
I'm waiting for the AI goodies, and then maybe, we do the hardware upgrade, and then you get the AI goodies, and it might make sense. Until then, I'm not sure it makes sense for me. I don't know if it makes sense for you. Danny, thank you. Your week ahead looks like this. Federal Reserve decision Wednesday, sandwiched between some economic data. On Tuesday, retail sales. On Thursday, we'll get jobless claims. Out just moments ago, Empire Manufacturing. Mike McKee around the table with us for more. Mike, what have you got?
Well, this isn't a major indicator, but it is interesting because going into the Fed meeting, we're seeing some expansion in the New York region. The general business conditions indicator rises to 11.5 from negative 4.7, so a fairly large move. New orders, shipments, inventories all up. The only thing that's really down is prices paid, and the number of employees improves, but it's still negative. So there is some signs that the economy is hanging in. Whether you put a lot of weight on the Empire number or not, it is maybe a small thumbnail on the scale.
To be clear, we had another thumbnail on the scale last week. Jobless claims were pretty decent. Jobless claims have been okay for the last 4 weeks. There's still this real sense that we're so finely balanced that all it might take is a soft retail sales print to all but confirm they're going 50 on Wednesday. What do you make of how people are talking about this decision going into Wednesday?
I think it's the first time that we go into a meeting in years without knowing what they're going to do. And so and it's a finely balanced decision. So people are trying to guess one way or another, and you're basically bringing your own biases to it. Whether you think that the Fed should be doing 50 or 25 is what you're going to end up predicting at this point, because you don't really know. And to the extent there were leaks to newspapers last week, they didn't give you any kind of definitive answer. They just raised the question, the possibility that the Fed could do 50. So it gives the market something to look at if they want to do that and not freak out if they were betting 100% on 25.
Mike, what's the risk of this ambiguous approach, basically, as we head into the decision?
Well, it's probably more of a risk that they've put out the possibility of 50 if they did 25, because then the markets are going to react to that. But you've got the other side of, if they do 50, then what do they know that we don't know? Ian Lingen from BMO put it well this morning. He said basically the markets are going to price the next 12 months based off of what we get on Wednesday. And if you do 50, then they're going to start looking at 50s going forward at a more rapid rate, down to whatever they think neutral is going to be, which was 2.7 last time.
Lots of buzz around the Bill Dudley piece, former New York Fed president, and Bloomberg opinion this morning. The Fed should go big now. I think it will. I know you've read the piece. I'd love your thoughts on it. What do you make of it?
Well, he makes a very good argument for his side. Greg Ip in the Wall Street Journal yesterday, published last night, makes the same case that the Fed is maybe behind the curve and it's better to do 50 now and get started on that so that you don't fall too far behind. The problem there is the people who make the case for 25 bring up the way the market's going to react to this.
Yep.
And so you've got some real countervailing views here, and it would be great to be a fly on the wall in the meeting. Normally, they go into the meeting with a decision pretty much made, because Jay Powell talks to them all on Friday, and they all tell him where they're going to be, and he can persuade people. But in this case, you get the impression that he's going to let people talk.
They always say every meeting's a live meeting. For the first time in a long time, as Mike said, this is the first time in a long time it actually feels like a live meeting. Mike's going to stick with us. Mike's in Lisa's chair. If you're wondering where Lisa is, she's run off for jury duty. She's hoping she's going to be back tomorrow. We hope she's all back tomorrow and not lost for several weeks. Joining us now is Greg Dakov, EY. Greg, good morning to you, sir.
Good morning.
I said as you walked into the studio, this is getting so tedious for so many people, because we all know that not all 25s are created equally. Not all 50s are either. And it's only one piece of the overall puzzle for the Federal Reserve on Wednesday. What are you and the team looking for?
Well, we're still looking for 25. We're not going to change our call at the last minute. I think there's a lot of movement in terms of market pricing that has come off of these two articles, the Wall Street Journal and Financial Times last week. But I think the uncertainty is still quite high. And as Mike was saying, it's all about how Fed Chair Powell manages to convince or not the rest of the policymakers. I think there's a strong split within the FOMC as to Fed Chair Powell, perhaps Governor Waller, open to front-loading rate cuts, to catching up a little bit, because they do realize that the economy is weaker than they had been anticipating. But most other policymakers still remain extremely data point dependent. And the data, as of the last few days, has not been sufficiently weak to convince them of a 50 basis point rate cut.
Let's start with the chairman and then get to the rest of the committee. I want to share two quotes with you. One was from the start of summer. The other quote was towards the end of summer, and both are from Chairman Powell. In Sintra, Portugal, Chairman Powell said, because the US economy is strong and the labour market is strong, we have the ability to take our time and get this right. Then at the back end of August, the end of summer, he said, we do not seek or welcome further cooling in labour market conditions. Given the data we've had since Jackson Hole, which chairman shows up to this FOMC meeting?
I think it's still the latter one, the one from Jackson Hole, saying that he does not seek or welcome any further weakening in the labor market. We have seen an environment where I think the main issue from the Fed side is the communication issue. We have seen a lack of communication as to a couple of things. One, the destination of travel, where the neutral Fed funds rate is, and two, how to get there, the destination. Those are the more important factors than whether the Fed goes 25 or 50 basis points. As Mike was saying, there is asymmetry around the fact that the Fed goes larger or smaller in terms of rate cuts. But what really matters in terms of how monetary policy is going to affect the economy is how rapidly we get to any form of neutral monetary policy stance.
When it comes to that communication, are you expecting clarity?
Perhaps a little bit more clarity, perhaps a little bit more transparency in terms of the fact that the timing and the pace of rate cuts will depend on the totality of data. That may be a shift in the monetary policy statement, arguing for a framework that is a little bit more forward-looking. I think that's what we've been lacking all along. Data dependency was the main theme. This is a good slip of words, but data point dependency has become the norm. It was all right when inflation was rising extremely rapidly and you wanted to make sure you were really adopting the appropriate monetary policy stance. It's no longer optimal. You want to look ahead to where inflation is going to be in a year's time, where the labor market's going to be, and where income is going to be. Because I've argued in the past that we're not paying sufficient attention to income trends. Income trends are much weaker than GDP data and consumer spending data, and income, in the end, is the main pillar to economic activity.
Well, if you think that, then should they go 50?
I think they should go 50, yes. I think they should catch up. I've been arguing for a while now that they should have started easing back earlier this summer. Why? Because you want to go gradually. When you're uncertain, you're rather better placed to essentially ease monetary policy gradually and avoid these hesitations, or what seems like hesitation, in going larger rate cuts. So I think, yes, they should have gone earlier, and that may be one of the justification that Powell uses if the Fed does decide to go 50 basis points, that they did not ease in July. It may have been optimal to do so, therefore we're catching up. And that's where the whole dot plot discussion is going to come into play. How many rate cuts are expected before the end of this year?
Well, you said coming in that this is a communications issue for the Fed. What does Jay Powell say if they want to do 50, or if they do 25? Half of the people on Wall Street are going to be upset they didn't do 50. The other half, if they do 50, is going to be upset they didn't do 25. So what does he say? How does he sell this to the markets?
Well, I think he has a great opportunity to set up a framework in terms of the monetary policy setting. He needs to acknowledge the fact that we're traveling towards some point, and that we'll get there either fast or slow. That communication will be essential because, as I said, if the Fed does less than what markets are anticipating, then there's a risk of essentially a repricing in markets the other way. A lot of people were asking me, what does a 25 basis point cut really do to the economy? Well, not much. It doesn't lower consumer rates much. It doesn't lower mortgage rates much. What happens if the Fed does not cut is much more dramatic because a lot of rate cuts have been priced in. So you'd see a significant increase in yields that would be much more dramatic and much more hurtful for the economy.
There's a lot of weight on this meeting because there is a real belief it sets the tone for the rest of the rate cutting cycle. I just wonder if we're overdoing that. How different things might look on November 7th, on December 18th, when we have more clarity on the outlook for policy down in Washington, D.C. Could they turn out to be the more pivotal, more important Fed meetings in 2024?
Perhaps, because we have a lot of uncertainty on the political front, as you well know. And one of the things that some have been arguing is that the Fed is just now catching up to the first stage of monetary policy. The second stage is what happens to the economy under different presidencies. Do we get an inflationary environment next year with more tariffs, reduced immigration, and more potential influence on the Fed? Do we get a scenario that's more likely to be a status quo type of environment where the economy continues to slow? That is highly uncertain. And so when the Fed does not know, it tends to go slow. That's the Brainerd principle, right? We're in this environment where there's a lot of uncertainty as to 2025. So let's focus for now, and policymakers should do that. Focus on the end of the year, focus on what you know, and adjust monetary policy to today's economic conditions and expected conditions over the next 3 months. And then in November, December, January, start to recalibrate policy as to what is expected on the policy front.
Clear thinking, great stuff as always, Greg. Thank you, sir.
My pleasure.
Greg Dacko of EY. Greg's view essentially, we think they'll go 25, but they should go 50. The difference between what they will do and what they should do is 25 basis points. The difference between 25 and 50 for most of you is going to come down to very, very fine economic data points. And it could be tomorrow morning with retail sales just around the corner, tipping the scales between 25 or 50 on Wednesday afternoon. Equity futures going into the opening bound negative by 1/10% on the S&P 500. On the Nasdaq 100, we're down 0.5%, coming off the back of the biggest weekly gain on the S&P 500 so far, and on a 5-day winning streak on the S&P into Monday. In the bond market, we look like this. 2-year, 10-year, 30-year. On a 2-year yield, we're down by 3 basis points. On a 10-year, we're just about unchanged at 364. Unlocking a little bit of dollar weakness against the Japanese yen. Dollar yen breaking through 140 earlier on this morning for the first time this year. briefly, back to about 140.36 on the session at the moment. With us around the table now, jumping into the studio, Megan Robson of BNP Paribas. Megan, good morning to you.
Good morning. Thanks for having me.
We were just talking about how this story might change from September into November, into December, and take on more of a political twist. And when I'm reading your research and your views on credit, this is heavy on politics, isn't it?
Exactly. So our view heading into the next 6 to 8 weeks is bearish on credit. We think investors are sort of underappreciating policy risk. And typically when you head into an election, you see volatility rise. And given you have a binary outcome with two very different implications, investors tend to de-risk their portfolios, reduce risk positions, and that causes credit spreads to widen. So heading into November, we do think credit spreads will widen.
Is that a story about positioning and pricing and not policy? Or does policy factor into this?
I think policy certainly factors in. I do think you have two very different candidates. If you take an issue like corporate taxes, for example, if you get a sweep in either direction, you could see net income up 7%. On the other side, you could see net income down 7%. So I think that uncertainty and inability to predict either outcome really drives the de-risking into the event. Following that, I think depending on what outcome we get, we can see dispersion based on who wins in not only the presidency, but also in Congress.
Is your best case for the credit markets, though, to basically maintain what we have right now, which is gridlock in Washington?
Exactly. I think the best case for most investors is a divided government scenario where having a Democratic president, potentially divided Congress, means that we have status quo, not a lot of new policy. I think in a Trump scenario, a lot of folks generally assume that's going to be more pro-market, but in our view, there actually could be a lot of macro headwinds should we see new tariffs and potential trade war. And remember, a lot of that policy, you don't need a unified government to get. So that's irrespective of what happens with Congress.
So are you basically saying Trump is worse for the credit markets?
I think it's a little more nuanced than that. I think you do get a tailwind from potentially lower taxes. It would require a red sweep to get that. But there is definitely the risk of a headwind if we do see broad-based tariffs as he's proposed. He's proposed, as you know, 10% global tariff, 60% on China. Whether he'll be able to get that extreme type of policy passed remains an open question. But in our base case, if he does do that, we would see a decent uptick in inflation. And then I think it's going to call into question, can the Fed actually resume this rate cutting cycle, which is a headwind for credit?
Well, let's get to this rate cutting cycle, 25 or 50. I want to spend some time on the 50. Two-part story. The first part is they go 50 and you're worried about them knowing something you don't know.
Yes.
The second part is they go in 50 and you're thinking they're getting ahead of the curve here. It's good news. Do we respond bullishly to this or bearishly if they go 50?
I think bullishly if they go 50. Credit is set up, in our view, for a 25 basis point cut. There is this assumption that potentially the Fed knows something we don't, but I do think they'll extrapolate, wow, the Fed's going to be aggressive. We're going to get growth that's held up okay with aggressive rate cuts. And I think credit initially would react very bullishly. We would see tighter spreads. Beyond the near term, of course, depending on whether we get a soft landing or a hard landing, that will ultimately drive where credit spreads grow. So we'll be data dependent. But initially, I think that would be bullish for markets.
Well, given your political outlook, does the market immediately, if the Fed does 50, price in 50 in November, 50 in December, and just an accelerated pace all the way along?
I think it's definitely possible that if we get the initial 50, there's going to be an extrapolation that we could see further aggressive policy, not only this year, but heading into next year. But we think that 25 is appropriate. We have a 75 basis points in our base case for 2024 this year, and then next year, 125 basis points. So I think that outcome is what is roughly priced into credit consensus. Anything more than that in the dot plot or in 50, I think will cause credit spread rally.
Don't you wish we could just get this decision done today?
Yeah.
At 2 p.m. Eastern time? Just get it done on a Monday, Mike? Get it finished with? You're all excited. I think
I'll go catch the plane right now.
The first live meeting in years for the Federal Reserve, but this one feels a bit tedious, doesn't it?
Well, it does in that sense, but what's going to be really interesting is to see what they put in their summary of economic projections is how do they see inflation and unemployment moving, since they pretty much got it wrong in the June SEP, and now where do they go for going into next year? And then how does that square with whatever monetary policy decision they make.
Yeah, putting together the December summary of economic projections might be challenging. Megan, thank you. It's good to hear from you. As always, thank you very much. Megan Robson there of BNP Paribas. Equity futures on the S&P just a bit softer, down 0.1%. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. BMW took over 2 years to discover the extent of a braking system fault. A recall document seen by Bloomberg shows that customers and dealers began complaining about the faulty brakes in June of 2022. But it wasn't until October of last year that an in-depth review was launched. The fix is expected to cost the car maker over $1 billion. TikTok is taking its fight against a U.S. ban to the next level. The U.S. Court of Appeals for the D.C. Circuit will hear arguments against a new law signed by President Biden, which bans a social media app unless its Beijing parent company ByteDance sells it. ByteDance, TikTok, and a group of its users will argue to a 3-judge panel that the law violates the Constitution's First Amendment. And the history-making Polaris Dawn crew is back on Earth. The SpaceX capsule splashed down off the coast of Florida early Sunday morning after gliding to the ocean under 4 parachutes. The highlight of the mission was the first commercial spacewalk conducted by billionaire Jarek Isaacman and SpaceX engineer Sarah Gillis on Thursday. And that's your brief, John.
Danny, thank you. Thanks for this morning. Just phenomenal stuff at SpaceX. Congratulations to everyone over there and the whole of the team. Equity futures right now slightly negative on the S&P as we count you down to the opening bell. Up next on our program, we'll set you up for the week ahead and catch up with Bloomberg's Ira Jersey about how this market is priced going into Wednesday. .38 minutes away from the opening bell on a 5-day winning streak on the S&P 500 and equities pulling back 0.1%. Equity futures just a little bit softer. Bond market stable, 365 on 10s. And in the FX market, the dollar near the weakest level of the year to kick off a week with euro dollar at 111 and dollar yen around 140. Let's get to the calendar. The trading diary for the week ahead looks like this. Tomorrow, retail sales and the Fed kicking off its 2-day meeting. Wednesday, a Federal Reserve decision followed by a news conference with Chairman Powell on Thursday. Another round of jobless claims plus a rate decision from the BOE. Then on Friday, it's the Bank of Japan's turn. The week is absolutely stacked. Joining us now is Ira Jersey of Bloomberg Intelligence. Ira, welcome to the program, sir. Walk us through how we're priced, what we're looking for, 25 or 50, going into Wednesday.
Yeah, so the market's definitely leaning toward a 50 this week. And interestingly, and I think that this is something that's been missed by a lot of people who are kind of tourists in the rate market, but we're priced for almost 125 basis points by the end of the year. So that implies that if the Fed does go 50 this week, that they're going to go 50 again either in November or December. So if the Fed were to come out with dots that were suggesting that there's only going to be, say, 100 basis points, and Powell makes that very clear, then you can wind up seeing something like the 2-year note actually sell off a little bit, and the front end yields go a little bit higher just because of what we're pricing very aggressive Fed cuts for the rest of the year.
Ira, you mentioned the dots. Let's just pick up on that. Do you expect the summary of economic projections to validate market pricing?
I don't actually. I do suspect that the Fed wants to go more cautiously than what the market's currently pricing. So if the dots do show 100 basis points and Chair Powell is able to make a compelling argument to the market for that, I suspect that we'll actually not validate the pricing, and you could see January Fed funds futures sell off a little bit. Importantly for the longer end of the curve and for what the shape of the yield curve will ultimately do, the end of 2025 dots will probably be far more important to the price of the Bloomberg Treasury Index, because the market tends to focus on not what's coming up near term, but what the Fed thinks it's going to do, and therefore what the market expects the Fed is going to do over the next 15 to 18 months. So that 2025 dot will be very important, and especially if they move that lower as well from the current very modest cuts that are expected in 2025. If those extend, then you can wind up seeing even a more broad rally in the Treasury market.
Ira, when it comes to this debate of 25 or 50, do you think politics has any impact at all?
Probably not. I mean, in the back of their minds, I think it has to. Certainly, the policy implications of having one candidate or the other will be, has to be there. So, if you have more protectionist policies that potentially make goods prices go up in the U.S., that does have a policy implication. But overall, the Fed has to look at what does the incoming data show. Are we worried more about inflation or more worried about the jobs? And right now, they've made it very clear that jobs is their primary concern right now. And that's a major shift, obviously, from where we were a year and a half ago, where they didn't care at all about the job market. It was all about inflation and only inflation. So I suspect that that's something that's going to, that politics matters, but not that much.
Ira Jersey of Bloomberg Intelligence. Ira, thank you, sir. Particularly after that Jackson Hole address from Chairman Powell, it felt like this central bank was a single-issue central bank. But this time the issues changed. It was no longer about inflation. It was now just about the jobs market. Jobless claims come on Thursday. Tomorrow morning we get retail sales, the big one, sandwiched in between. The Federal Reserve just around the corner. Our lineup tomorrow, Greg Davis of Vanguard, Katie Kaminsky of Alpha Simplex, Blarina Urucci of T. Rowe Price, and Ashok Bhatia of Neuberger Berman. The good news is we're getting closer and closer to actually getting a decision and settling the debate. 25 or 50. From New York, this was Bloomberg Surveillance.